this looks like a time of both opportunity and risk.
The context in which the economy is set up for in 2025 under Trump presidency is beneficial for small, medium, and larger sized companies.
I think that the tech stocks and the tech sector is going to continue to perform fairly well.
I'm a little less concerned about concentration. I mean, I think those companies are performing well for a reason.
We'd expect another strong year, just not to the same extent of 2023 or 2024.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday on a 5-day slide on the S&P 500, the longest losing streak going back to April of last year. Equity futures attempting to bounce back, up 0.2% on the S&P. On the Nasdaq 100, up by a third. The headlines of the last 24 hours in foreign exchange. Check out these two currency pairs. Euro-dollar breaking down to 102 for the first time since 22. Dollar-China breaking through 7.3 for the first time since late 23.
And what's the feature of both of them? A strong dollar. And that has been the story of last year, and it continues to be the story of this year as people start to wonder how much they are overpricing rate cuts, even though they've already priced out so many in the United States due to that U.S. exceptionalism story that is becoming increasingly unique.
How much of this will China tolerate? Or should I say, how much of this will China embrace? Reuters reported on this last month. I pulled up the quote for us from a few weeks ago. China's top leaders and policymakers are considering allowing the yuan to weaken in 25 as they brace for higher U.S. trade tariffs as Donald Trump returns to the White House.
There is a theory that essentially a weaker currency is the best thing for a nation that is looking to increase its exports, that has an overcapacity issue. They've been overproducing, and now they want to support their economy by making sure people buy those goods. A weaker dollar benefits that, which is the reason why when you look at all the reporting on the yuan weakening, it is China letting this happen because it is a completely managed currency. And this might be something that not only do they just tolerate, but they actually, as you say, embrace.
The Chinese yields have fallen off a cliff over the last several months. Compare that to US yields, which remain pretty elevated. Another spread I think we all have to look at as well. Europe versus the United States. Growth expectations. Apollo's Thorsten Slock has talked about this a number of times over the past few weeks. They've opened up in a major way.
Yeah.
How and if that spread reconciles over the next several months is going to be critical to a number of asset classes.
Especially because there are two aspects of this. First of all, Europe has seen really weak growth. We saw that with the PMIs yesterday. We've seen a divergence where some of the historically stronger economies in Europe have done the worst, like France, like Germany. But then there's a question of expectations and how low they are. And this really is the key question to me. How low have expectations gotten, and has that created a bar that is so low that essentially Europe is going to look attractive even if it just doesn't fall off a cliff?
How little needs to go right to turn this story around on the screen? A 102.83 on euro-dollar. Check out this single name, one stock to watch this morning. US Steel. Negative in the pre-market by close to 9%. The reporting from the team here at Bloomberg, we're close to President Biden saying no deal.
Even though some of his advisors are encouraging him to say yes to this deal, honestly, everyone is probably sick of this story because we talk about it every single day. It might happen. There's a sweetener. It's not going to happen. And now we've got the sense that maybe today is going to be the day that we finally end the discussion. Nonetheless, it sets an interesting tone going forward about who the United States' allies are and what is considered national security at a time where ostensibly deal-making will be coming back and ostensibly foreign investment will be welcome, but from where?
A big conversation on that coming up later this hour throughout this morning. Coming up through the next 60 minutes, we'll catch up with Priya Misra of JPMorgan saying rates are near their peak. Jamil Jaffer of the National Security Institute as Biden plans to block the sale of US steel. And we'll catch up with Daan Struyven of Goldman Sachs on why gold is heading to 3,000. We begin this hour with stocks looking to snap a 5-day losing streak as higher bond yields begin to constrain risk assets. Priya Misra of JPMorgan writing, rates have risen a lot and it will be a problem for risk if the 10-year gets closer to 5%. This has been a real rate-led move, which is a problem. I think we're near the peak. Priya joins us now for more. Priya, good morning and Happy New Year.
Happy New Year.
Let's start with that real rate move. What do you mean by that and why is that so important?
Sure. So when we think about the 10-year, I think it's useful to decompose it. Is it inflation expectations that are going up? And if that's happening, if I'm getting paid more, I can pay more for things. I can pay a higher mortgage rate. If real rates go up, I think that's when we talk about is monetary policy restrictive. I look at real rates. This entire move really has been a real rate-driven move. Since the Fed started to cut rates, or since September last year, real rates have risen by almost 100 basis points. The 10-year Treasury is up by 100 basis points. And that just tells you that if they are trying to reduce that restrictiveness, well, they didn't really succeed on that front. Now, maybe the economy doesn't need significantly lower rates. I do think R-star or that equilibrium real rate is higher, but it's not here. And so the economy, which is sort of slowing, now we think we're in a soft landing, that's likely to remain. And the markets has repriced, I think, this sort of policy risk coming from the administration, all one-sided, meaning it's all positive growth, positive inflation. I would actually argue a lot of the policy risks are two-sided. You can have the negative growth, you can have the disinflationary aspect as well if we have immigration, certain aspects of the policy. So I think on the growth and inflation front, I do feel that interest rates have priced in a lot, meaning we've priced out the Fed significantly. And now if risk assets are looking at that real rate and saying, okay, whoever or whichever sectors were constrained by interest rates, that constraint is back. I think that's why I think risk assets are going to start to pay. I think they're already paying attention to rates.
Bond sell-offs can become self-limiting precisely because of this. And you're seeing sufficient evidence of that already to say that maybe we're at that point where the sell-off has got to that point in the bond market, or we're not there yet?
I think we're getting there. So you look at housing, you can absolutely see it there. Interest-sensitive sectors, I think you can see it there. Is that enough to spill over into the broader economy? I think we're getting there, which is why it's hard for me to say 4.5 or 460 is the peak. Maybe it's 475. Maybe it's 5. I even struggle with 5 because look at where Fed funds is. We got close to 5 when Fed funds was at 5.5. We're right now, for the first time in many years, an upward sloping yield curve. That front end is anchored. If you think the Fed's sort of done, which I actually don't think the neutral rate is 4%, the market's pricing in 4%. If the front end is pricing in 4%, how high can that term premium go before everyone that funds at that 10-year or the 5-year point, which is actually the large part of the economy, starts to say no mass? And, that's where you start to see the impact.
When you zoom out, last year I was thinking about this. What was the biggest mistake? It was essentially people were too bearish on risk assets, particularly big tech, and too bullish on the idea of rate cuts and how many would be baked into the market. Are you saying that essentially you could turn that on the head this year? That essentially people are too bullish on risk assets and too bearish on the prospect of rate cuts at a time where people are assuming that the neutral rate is significantly higher than where you see it?
Great point. I think a lot depends on positioning. I think we've come into this year with no bond bulls. I mean, if you find one, I would love to hear. I'm the one arguing we may be near the peak. I'm not even saying that rates are going to go down significantly. Last year was a little different, meaning people were thinking, oh, the Fed's going to cut, and historical cutting cycles are 200, 300 basis points. We didn't get that. We got 100. And the Fed is saying, well, the first 100 was easy. I think the issue is we're debating structural issues. You just brought up neutral rate. Is inflation going to continue down to 2%? Do we get stuck there? We're also debating cyclical issues. What are we going to get from this new administration? There's so many policy, risks out there. So I think we're debating structural, cyclical. The Fed's saying, well, we're not in any urgency. We can stop. And that's why the market narrative shifts from one end to the other. We're right now at one end. All the positive news is priced in. There's this higher for longer narrative. But there's a self-limiting aspect to this in terms of, expectations, in terms of all the markets have to make sense in equilibrium.
We were speaking with Stuart Kaiser of Citigroup yesterday, and he said that the bigger risk right now for risk assets would be if you actually got a huge rally in treasuries, if you essentially had yields going to 3% on the 10-year, because that would indicate something so negative is happening in the economy that it couldn't support this sort of American exceptionalism story. Do you disagree? I mean, do you think that essentially those rate cuts could be considered a positive if they are accompanied with the ongoing soft landing and disinflation that some people were talking about last year?
Yeah, I'm not sure. Now, 3% is a long way from here. That's a 150 basis point drop in rates. I don't know how that happens without the economy really slowing down. So maybe I wouldn't disagree that if you get a 150 basis point decline in rates, that's probably because we have a really bad payroll report, because the economy looks like, well, maybe we're going from soft landing into weaker. So maybe at that point, it's a problem for risk assets. I don't think the first or the next 50 basis points is a problem. I actually think that'll be embraced by every market, because how do you get that? You get that if inflation continues to head slowly, in our view, slowly but surely, it is heading close to 2%. Because you look at the underlying of inflation, it's really housing inflation, it's motor vehicle insurance. These are imputed lagging indicators. If inflation starts heading low and the Fed says, we said we were going to cut 2 times, here's a cut in March, which has been taken off the table, or there's a cut in April that's coming, and the market says, okay, we don't have to price in a 5% 10-year, we can go back to a 4 to 4.5%, maybe 3.50 to 4.5%. I'll give you a wider range. I think that's a sweet spot for risk assets, allows the soft landing to go on. It allows monetary policy to take the edge off the sectors for whom interest rates matter.
I think overall this narrative's still pretty jittery. It would only take one bad payrolls report next week to completely change the conversation all over again. You were looking for bond bulls. I don't know about bond bulls, treasury bulls. I can find a ton of credit bulls. They've come on the programme with Lisa, me and Anne-Marie multiple times over the last several months, and the argument has been pretty consistent. Spreads are tight, sure, but all in yield, very attractive. How powerful is that as an argument, and does it seduce you?
It's a very powerful argument. Now, I would say I won't just look at all in yield. I would also look at credit fundamentals, corporate fundamentals. They're very strong. So those spreads you reference, historically, they're tight. They are tight for good reason. I mean, look at high-yield default rates, including the restructuring that we've seen, 1.5%. So the high-yield market, I think, is much stronger. Now, I do think in a high, and we can debate, is neutral rate 3 or 4, but it's higher than 0. And so when cost of capital is high, I think dispersion is going to be much higher. So you have to do the work. I think you have to be diversified. You have to make sure that you know the companies that you're buying. We don't like some of the distressed high-yield sector, I think, because it's idiosyncratic there. But high-grade high-yield, high-grade corporates, where, I think the company fundamentals are solid. We're seeing continued inflows into bond funds. I think people are rebalancing. They're realizing that 2 years back-to-back, 25% equity returns. You have to say, okay, maybe this is going to slow down. And that's when these bonds, if you're getting 6-7% in bonds, in an uncertain environment, that's a pretty compelling argument.
Do you think this is going to be the year that public credit outperforms private credit? Given how much enthusiasm there's been around private credit, how much money there's been that's flowed in, and how much loosening of covenants we've started to see?
I am a little concerned. But the issue is with private credit, do you have enough transparency? Will we know? So I do think if rates stay high, yes, I would argue that public credit can at least catch up to private credit. Whether we'll know where the restructuring or the demons are in private credit, I think that's another question. But I do think public credit, there's value in it. The interest rate move has created the value, not spreads, but just where we are in terms of all-in yield. With that, think of Sharpe ratio, where the volatility is. This is attractive to be in fixed income.
Priya, it's good to see you, as always. Thanks for being here. Priya Misra there of JPMorgan. Just to check out the equity market, equity futures declining from the highs, still positive on the session. We're up by about 0.2% on the S&P. With an update on stories elsewhere this morning, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Sources tell us that President Biden will block the sale of U.S. steel to Japanese-owned Nippon Steel today. Shares down 8.5% pre-market. President and President-elect Trump both opposed the $14 billion takeover. The CEO of U.S. Steel recently argued that the merger would help combat China's global grip on the steel industry. The companies say that they plan to pursue legal action if Biden does indeed formally block the deal. U.S. investigators say that there's no evidence linking the deadly attacks in New Orleans and Las Vegas on New Year's Day. There were similarities in both, however. Suspects were U.S. Army veterans who used the same app to rent electric vehicles. The man who drove into a crowd in New Orleans, killing 14 people, had claimed to have joined the Islamic State. An official says that there's no evidence, though, that the jihadist group coordinated the attack. Apple is offering discounted smartphones in China. Reuters reporting that the discounts will run from January 4th to the 7th and will knock 500 yuan off the iPhone 16 Pro and the Pro Max. Apple shares fell 2.5% on Thursday following that report, which is a 4th straight day of losses. That's your Bloomberg Brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, the end of the U.S. Steel saga.
U.S. Steel has been an iconic American company for more than a century, and it should remain a totally American company. That's going to happen, I promise you.
We're getting closer. We're getting closer. That conversation just around the corner. Live from New York City this morning. Good morning. looking to snap a 5-day losing streak on the S&P 500, just about positive by 0.2%. On this morning's session, in the bond market, really strong bid this time yesterday. We gave a lot of that up after we got some jobless claims numbers that were much better than expected. The 10-year yield this morning just south of 455 at 454.71. Under surveillance this morning, the end of the U.S. Steel saga.
U.S. Steel has been an iconic American company for more than a century, and it should remain a totally American company. That's going to happen, I promise you.
I would not let U.S. Steel be sold to Japanese, by the way. I would stop it if it hasn't been completed by the time I'm president.
So here's the latest this morning. President Biden looking to block the sale of U.S. Steel to Japan's Nippon Steel after more than a year of opposition to the deal. The White House set to announce the decision later on today, with questions mounting on what's ahead for both companies. Bloomberg's Mike Shepard joins us now for more. Shep, welcome to the programme, sir. How close are we to closing a book on this whole story?
Well, it could be a matter of hours, at least from the administration's point of view. We're expecting President Joe Biden to actually put out his announcement of a decision to block the deal. He had not said outright, neither had the White House, that he would actually do this. But for months, and we saw in that clip going back to April, he has signaled his opposition to this deal, which was announced more than a year ago. And the opposition that the administration has cited is rooted in not only national security grounds, but political grounds. You'll see in that clip, he is surrounded by steel workers. And this was very much an issue that was sensitive for this pro-labor president, somebody who also has roots in Pennsylvania, which is where U.S. Steel is headquartered.
Let's say that this deal really is over at this point, Mike. What happens to U.S. Steel?
Well, it's a great question, Lisa, because they're going to have to go back to the drawing board quickly. They had made clear from the start, when the deal was announced back in December of 2023, that they needed this investment, this partnership with Nippon Steel to help invest in the U.S., to help preserve jobs here, to help upgrade and improve manufacturing capacity. And the two companies had argued this as a way to counter China's growing dominance in the area of steelmaking. So not only will they have to go back to the drawing boards, they're going to have to think about whether they need to engage in some asset sales, whether they need to look for another possible merger partner. In the past, Cleveland-Cliffs, another competitor, has expressed interest in acquiring at least some, or if not all, of U.S. Steel. But we don't know now, after this year-long saga, whether that ardor and interest in acquiring any of U.S. Steel's assets remains on Cleveland-Cliffs' parts. The two companies, U.S. Steel and Nippon Steel, have signaled that they intend to take this decision to court once it comes out. So we'll have to see whether the courts can provide any relief and maybe perhaps reverse this decision. But that is an uphill struggle, given that national security implications are being invoked.
Hey, Shep, appreciate your time. Michael Shepard there, joining us from the nation's capital. Steel, US Steel, is down by 8.5% in the pre-market. Speaks to what you're talking about. What is the future of this company without that deal?
A lot of people were rejecting the Cleveland-Cliffs deal because it wasn't as positive. At the same time, if you can't have a foreign buyer come in, who then is a likely suitor at a time when they fall into the 27th biggest producer of steel in the world?
Let's continue this conversation with Jamil Jaffer of the National Security Institute. Jamil, welcome to the programme and Happy New Year to you. This country faces a lot of national security issues across several dimensions. Where does Nippon Steel taking over US Steel rank?
Well, at least as it goes to foreign investment in the United States, it's probably in the top 3 or 4 issues being addressed currently by the U.S. government. Obviously, you got the effort to ban TikTok going on or enforce a divestment of that. That's a huge issue in the foreign investment in the U.S. Arena. U.S. Steel is right up there with that. The number 3 U.S. steel producer, top 30 in the world, being taken over by one of the top 5 steel companies, or an attempt to take over by one of the top 5 steel companies in the globe. A big issue, and a big issue for unions. Labor jobs as well, for a president who lost his election, but it's facing the same problems from the incoming president, Donald Trump.
Begs the question, Jamil, we're meant to have a process. CFIUS is meant to take control of some of this for us. Do you think we've blurred the lines between politics and national security? And is that problematic?
Yeah, I mean, look, the challenge is, of course, that it's always been a political debate as well. And the national security concerns have always weighed into the CFIUS process. They're at the core of the process. In this case, as you know, the CFIUS committee decided not to make a recommendation one way or another, leaving it to the president to make the call. We've known about his opposition from a political perspective for a long time. The decision has ultimately been laid out in national security terms, again, because it's the third largest U.S. steelmaker after Nucor and Cleveland-Cliffs. So now the question is, can they find a U.S. substitute or a different purchaser? That's going to be a hard one. Cleveland-Cliffs made an offer in 2023. There's a bidding war. Nippon won that bid. So will Cleveland-Cliffs come back in? We'll see.
Jamil, there's a larger question here about who the allies of the United States are. And is it important to solidify some of those bonds? I was reading about a Japan economy minister who came out and basically said, if this deal is rejected, it will send a stark message that investment from Japan, regardless of lack of security concerns, is not welcome in the U.S. How concerned are you about the U.S.'s efforts to fortify its connections with allies at a time where threats elsewhere, as we've just seen, are still dominant?
No, this is a great point, right? I mean, the challenge is that we're facing a decade-level threat in China, both economically, politically, and militarily. And one of the points that the U.S. government has made repeatedly, and U.S. Political leaders have made repeatedly, is this is an opportunity to work closely with our allies. We've got to work with allies to be successful in the long-term battle, both politically, militarily, and economically with China. And of course, the rejection of a major deal with a critical American ally, the Japanese, is a hard one. President Trump has welcomed the large investment that SoftBank, a Japanese entity, is making in the U.S. in artificial intelligence and other areas. So the question is, on one hand, you're willing to accept the AI investment. On the other hand, not willing to lose an iconic American steel company in part because of labor concerns. How do those weigh in? And what does it say to our allies, not just in Japan, but in other parts of Asia and Europe as well, as they all look to see, will the U.S. be a good ally, a good economic partner, or should they turn to face China? Right? The U.S. needs to continue making that point. Our allies are important to us, even if we're not going to do this deal, which raises national security and political concerns for us.
John was talking about the myriad threats and the myriad national security concerns. And I think about the attacks that we saw both in New Orleans as well as in Las Vegas. And I just wonder, given that we have 17 days until the inauguration of President-elect Donald Trump, how much do you think that there is a sort of renewed fragility? Are you sensing a sort of increase in threats and maybe fragility in addressing some of them in the United States?
Well, look, there's no doubt that the U.S. is beset by threats all around the globe. We're in a situation today where we have wars raging in the Middle East, in Europe. We have a potential threat of a conflict with China in the South China Sea and the Taiwan Straits. We've got the threat of now the overweening threat of terrorism that's long been present, now back on our shores in a horrific fashion, with 14 dead in New Orleans, 7 injured in Las Vegas, and the potential threat for terrorism ongoing. The threat level has always been high for the last few years. It's going to continue to remain high. And the key is the U.S. has to decide, do we want to be a global leader? Do we want to engage in issues overseas and fight our battles overseas? Or are we willing to sort of step back, as both President Biden and President Trump have indicated, with the fear that if we step back, those threats might end up on our shores? We've seen the story before. The U.S. is best placed when we lean forward, are a strong ally to our friends and a strong adversary to our enemies overseas and not here at home.
Jamil, appreciate your time. No doubt we'll catch up again soon on several of these issues. Jamil Jaffer there of the National Security Institute. We've talked about this over the last couple of days. We face several threats across several dimensions. One is physical. We saw the tragic events over the weekend coming into the new year. The other is cyber. We've seen the cyber attacks that were allegedly coming from China towards the Treasury.
Yeah, and there are more details coming out about that in terms of non-confidential documents that scientists in the Treasury Department had. A key question here is who is overseeing all of this? Who is sort of drawing all the connections? Who is in charge? Is it local municipalities? Is it on a federal level? What Jamil was just talking about, this idea of how much do you want to commit to overseas conflicts versus domestic ones, and the intersection of those, the sharing of information, et cetera. That's something that the new president is going to have to deal with, as well as President Biden in his remaining 17 days.
The to-do list for the incoming administration is getting longer and slightly more complex as the days go by. Coming up next on the programme, we'll catch up with Dan Struyven of Goldman Sachs on his outlook for commodities and a big call on gold, and why gold is heading back towards 3,000. That conversation just around the corner. Equity futures on the S&P just about positive by 0.2%. 5-day slide on the S&P 500, the longest since April of last year, and we're looking to bounce. Equity futures on the S&P 500 up by 0.2%, on the Nasdaq up by 0.4. This time yesterday, it looked like we would get a bounce. That bounce very quickly faded.
And why did it fade? This, to me, was the interesting aspect. It was not because there was terrible earnings, although you did get deliveries that disappointed from Tesla, and that was one of the bigger losers. It was because yields started to creep higher. We had jobless claims come in at the lowest levels in 8 months. You had crude ticking up on the margins. All of a sudden, the same story that led to the losses at the end of last year regurgitated themselves once again to start 2025.
Bond yields close to 4.55 on a 10-year again this morning. Here's the shape of the yield curve: 2s, 10s, and 30s. The 10-year down a basis point to 4.54.51. Max Kettner of HSBC says we're in a danger zone. This is where you start to see risk assets get hurt. We heard a similar thing from Priya Misra of JPMorgan Asset Management, making the case that this is the point of the bond market sell-off where it begins to become self-limiting because of the damage it causes elsewhere.
If you think about it, this is the same conversation we had yesterday about real money accounts waking up to 4.5% 10-year yields and saying, okay, maybe it's hard to be bullish, but I wouldn't mind owning some of these. And that's what you're hearing on the margins, and this isn't even including foreign buyers. So you start to look at that and say, if this becomes an alternative, does that suck some of the oxygen out of the trade where everyone is bullish on U.S. equity assets?
Including the U.S. dollar. Check out the FX screen this morning. Just some major moves in the last 24 hours, some new levels to think about. Euro dollar breaking down to 102 in yesterday's session for the first time since 22. Dollar China breaking up through 7.3 for the first time since 23. These are some major moves in foreign exchange.
And they're distinct stories. On one hand, it's all a dollar strength story. With the European story, there's also this question of natural gas suddenly renewing a threat in terms of inflationary, stagflationary pressures at a time of PMIs coming in weaker than expected in China. This is a country that is in some ways very much flat on its back, as one Tom Keane would say, where you have a housing market that's imploded and they're trying to boost consumption as well as exports. A weak currency would be absolutely positive for that type of engagement. So you have to wonder how much, as we talked about, just a bit ago, this is welcomed.
They might embrace it. They might embrace it. And I think it also speaks to, or rather bond yields speak to this. Bond yields in China are collapsing, and I think the world needs to watch what's going on there. That economy, to your point, is not in a good place, and that's captured by the bond market in that country.
I just can't get over the fact that the losses tied to the housing declines that you've seen in China supersede and then some what we saw in the 2008 crisis in the United States. This is a huge loss of wealth. At a certain point, you've got China coming out and actually potentially using those low yields to issue bonds to potentially offer up some stimulus. How far can they go with that? That's one thing people are wondering.
We'll get back to the story and what it means for the commodity market in just a moment. Under surveillance this morning, the FBI saying the deadly attacks in New Orleans and Las Vegas on New Year's Day don't appear to be linked. U.S. law enforcement investigating both incidents as terror attacks, with officials determining the suspect in New Orleans acted alone.
This is a really strange incident, tragic incident, but also some of the similarities were very hard for people to ignore. They both served in the armies, both suspects. They both served in Afghanistan at the same time in similar units, not necessarily together. They both rented cars from Turo, the ride-sharing app, which is essentially Airbnb for cars. You put this together and you start to wonder, is there something more here? And that's the reason why they're still investigating.
And why people will keep asking the same questions. Any more information on this story, of course, we'll share it with you. Let's turn to this. President Biden planning to block the sale of U.S. steel to Nippon Steel. Sources telling Bloomberg the White House is set to announce the decision later on today. The move putting an end, potentially, to the $14 billion deal that has faced months of vocal bipartisan opposition.
I was looking overnight at the CFIUS ruling and exactly why they did recommend against this deal. They talk about potentially in the future U.S. Steel reducing output. This is something that they're concerned could reduce its role in international steel exports. They're worried that this would sort of be a concerted effort to reduce their dominance. At the same time, you've got Japan coming out and saying, really, guys? You're not gonna sign off on a deal with us, your friends? Well, that really raises questions about just how close our alliance is.
We've blurred the lines between politics and national security. And particularly under this administration, everything has become a national security issue. Everything under the sun. So it's difficult to draw a distinction between the things that are seriously national security issues and the ones that aren't?
This becomes increasingly important, especially if deals do come back, because how do you even evaluate what deals might come under the purview of CFIUS or national security if there isn't some sort of consistent standard? And I expect that to be a theme for 2025.
Talked a lot about China already in the new year. China expanding subsidies to cover smartphones in a bid to promote domestic spending. Officials announcing a national trade-in program that currently applies to home appliances and cars, and it will broaden this year to include personal devices like phones, tablets, and smartwatches. And this is the problem with consumption in China right now.
Especially because there is a question, if they offer it, will they come? Are they going to trade in some of these goods? They have tried these before and it hasn't necessarily boosted consumption. At the same time, it's giving hope to some people who are waiting for the bazooka, which is sort of the offerings, the chips that Chinese authorities have been putting out there that maybe it's coming. People are wondering if they're sort of waiting to just sort of shock the market and get some flows back.
It's very incremental so far.
Yes.
I think we're all sitting here still waiting. Let's turn to commodities. Gold closing out its strongest year since 2010. Daan Struyven of Goldman Sachs looking for prices to rally to 3,000 per ounce this year, writing US policy uncertainty and recent consolidation provide an attractive entry point for a high-conviction long gold view, with structural support from central bank gold demand. Dan joins us now for more. Dan, good morning and Happy New Year.
Good morning, Happy New Year.
I was going through your notes, sir. Tariff escalation, buy gold. Debt fears, buy gold. Geopolitics, buy gold. The list is pretty long. How much of this has been front-loaded already?
So we do like gold both in our base case because of the structural boost to central bank demand. Central bank purchases have increased by a factor of 5 since mid-22. That's the structural support. And on the cyclical side, we do expect 325 basis points Fed cuts to boost ETF holdings and provide cyclical support. That's the base case. But what's exciting about gold as an investment opportunity is the hedging risks. If you look at the two main risks that our US economists have laid out to the benign 2025 outlook, it's tariff escalation. And what did we see in 2018 when former and incoming President Trump announced tariffs? Gold ETF holdings and net spec holdings surged. The second risk to the US economic outlook is that the market starts to worry again about sovereign debt sustainability issues. And that's also an environment typically where gold tends to rally.
Do you find it peculiar that we're seeing some of these moves in gold, particularly through last year, at a time where the dollar is so strong against other currencies, like the euro, like the Chinese currency? Does that add up to you?
So we do find that rates are significantly more important than the dollar for ETF holdings. The big puzzle of the last 2 years has been the disconnect between strong gold prices on the one hand and on the other hand relatively high rates. The main reason for this decoupling in level terms between gold prices and the level of interest rates is structurally stronger central bank buying. But if you look at a higher frequency, if you look at changes, this relationship is very much intact. And in fact, our forecast for Fed cuts helps to explain why we expect gold prices to rise higher. On the dollar itself, we do, for instance, think that central banks who typically buy gold with dollar holdings are not going to be deterred by a stronger dollar. We also find that once you control for the level of rates, the dollar doesn't really matter for ETF holdings. And if anything, if we're in a strong dollar environment because of concerns about downside risks and tail risks, that's an environment where both the dollar and gold tend to benefit from safe haven demand.
Last year, people were really excited about gold as a possible inflation hedge. They were worried about upside inflation risk, and they were piling into the precious metal. Do you think at this point we've established gold as a better hedge against inflation than even oil?
I think it all depends what drives the inflation shock. If you were to see a negative energy supply shock, whether it is in Europe on the European gas side, or whether we would see fewer barrels coming out of the Middle East, for instance, because of Iran, then I think energy is still your place to go. Now, if inflation is, for instance, driven by markets becoming concerned about the credibility of the central bank, then gold tends to really rally. So I think it really depends on what's driving the source of inflation, and so we see a role for both energy and gold as inflation hedges in portfolios, even if our base case for energy prices is quite flat.
What's interesting to me is, as a commodity strategist, you kind of are increasingly touching all the different aspects, whether it's global growth or whether it's the idea of a debasement of a dollar and sort of some of the geopolitics with respect to looking for some sort of new currency. I am curious, when it comes to global economic trends, how much we've already baked in weak China, as we were just talking about, to oil prices, given the fact that that's been a known story and that we've been talking about how the pessimism is baked in, but not necessarily any optimism of a revival.
Yeah, so what's striking about oil prices in 2024 is that they came down somewhat in the second half, even if inventory levels, typically the key fundamental driver of oil prices, edged down. So in the first half, as in 23 and 22, we actually thought that oil prices were a little bit too high relative to inventory fundamentals because the market was focused on downside risk to supply from Russia and the Middle East. In the second half of last year, this flipped. The risk premium turned negative, and the market became focused on downside risk to China demand, the fear of an oversupply oil glut in 2025. And we think that the rally of the last few days partially reverses that. It's the sixth consecutive week where U.S. crude inventories grew. And so our view is that oil prices are a few dollars undervalued right now. And that's why we look for Brent in the mid-70s, a touch above the low 70s we have been trading in for much of the last month.
We mentioned Chinese bond yields rolling over. There is some real fears about where growth is in a country right now. Where is demand for commodities in China? How are you tracking things?
It is very divergent across commodities. What's, for instance, quite striking is that if you look at the increases in demand for aluminium or silver, it's entirely driven by solar PV installations. If you're looking at ferrous demand, iron ore, steel, it's quite weak because the property sector continues to contract. And even on the energy side, there is quite a lot of divergence, with in 2024 LNG demand being pretty firmly supported by a strong export sector, but oil demand contracting slightly last year because of the quick transition to EVs and LNG-powered trucks. So the overall answer is it depends on what commodity you look at. What's the implication for investors? You need to be differentiated in your investment approach if you think.
Well, if I look at iron ore and steel alone, doesn't that tell me the economy is pretty weak? Doesn't that give me the better cyclical read on things?
It gives you a very good read on the property sector, which continues to be very weak. But you are seeing pockets of strength. You mentioned the trade-up program for consumers. We're seeing very strong appliance sales. We're seeing strong EV sales. And that's positive for the base metals.
When we talk about some of the transition to green energy, we talked about how that was one reason why there hasn't been as much demand for oil, even as you did see the U.S. increase, the electric vehicle usage, et cetera. Do you still think that that's a case to be made at a time where people are saying that the big challenge, especially with the AI transition, is there just isn't enough energy sources and you need to even start burning coal again in mass amounts because you have to basically fortify some of the energy demands?
So we think that global energy demand will continue to rise very significantly because the middle class in emerging markets will continue to require more energy, and because of this new source of energy, and especially power demand growth, which is AI. Our equity analysts are quite bullish on U.S. power demand, expect a 90 gigawatt increase by 2030 for U.S. power demand coming from AI and data centers. I think the big challenge will be with a lot of the additions on the power side coming from renewables, which is an intermittent source of supply. How are you going to serve all that extra power demand when the sun is not shining or when the wind is not blowing?
Well, this is the reason why. Are we underestimating how much demand there's going to be for oil, for gasoline, at a time when potentially you can't get enough power? And that's been the discussion that we've had with every single technology analyst who's come on this show.
I do think that the world needs to invest more in the power sector, in the grid. I spent my holiday vacation in Puerto Rico. It was a terrific time there with the family. But we had power outages, not ourselves, after we left just a few days ago. We had very significant power outages last year in India, where power demand is growing at almost 10% of an annualized rate. So I think that's one of the major challenges for the commodities complex.
Dan, appreciate your time. Thank you for being with us. Dan Struyven there of Goldman Sachs on the commodity market with a range of calls, including gold, getting back to 3,000, back towards 3,000. Gold this morning just about unchanged at 26.58. With an update on stories elsewhere this morning with your Bloomberg brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Political instability in South Korea continues. Anti-corruption investigators in the country tried and failed to arrest impeached President Yoon Suk-yeol. They wanted to question him as part of an insurrection probe after his martial law declaration in December. Opposition politicians are urging the anti-corruption officials to try and rearrest Yoon again immediately. Yoon's representative called the arrest attempt illegal. U.S. bank reserves have fallen below $3 trillion. That is the lowest since October 2020. A Fed report states that reserves fell by about $326 billion in the week through January 1st. That's the largest weekly slide in over 2.5 years. The decline attributed to year-end dynamics, quantitative tightening, and loan repayments. The Fed's continued removal of excess cash as it shrinks its balance sheet is raising concerns about reserve scarcity. Meta replaced Nick Clegg as its president of global affairs with Joel Kaplan, a longtime executive with strong ties to the Republican Party. Kaplan has been advocating for allowing more speech from across the political spectrum on Meta's platforms. Meta has been working to repair its relationship with President-elect Trump, who has accused it of censoring conservative speech. And that's your brief. John.
Hey, Danny, thank you. Just an absolutely fascinating story in the last 24 hours. There's been a real sense, I think, in this country and beyond that we've shifted away from freedom of speech towards preferred speech, and a sense that liberal voices had the power in determining who could and who couldn't speak. There is another data point there in the last 24 hours that the wind is changing big time.
The Liberal Democrat from the United Kingdom being replaced by the Republican advisor to George W. Bush. A real question about what that means going forward.
Says a lot. We'll pick up on that story in about 45 minutes, so look out for that conversation. Up next, the strength of the American labour market.
If the unemployment rate flattens out at 4.2, 4.3, then I think the Fed's going to feel very, very confident about the labour market, and it might be difficult for them to cut any further.
That conversation up next, live from New York. You're watching Bloomberg TV. Can we get a bounce on this stock market? 5 days of losses on the S&P 500 so far this Friday morning, positive by just 0.2%. Under surveillance this morning, the strength of the American labour market.
We are seeing some signs of softness in the labour market, but it's been very gradual. And as long as it remains gradual, I think we can feel pretty confident that we're going to avoid a downturn. And better yet, if we actually flatten out, if the unemployment rate flattens out at 4.2, 4.3, then I think the Fed's going to feel very, very confident about the labour market, and it might be difficult for them to cut any further.
So here's the latest this morning. Investors looking ahead to key dates this month, starting with next Friday's payrolls report, followed by CPI and a Fed rate decision at the end of the month. Claudia Sahm of New Century Advisors noting the Fed's summary of economic projections isn't living up to promises, writing, tension has been building around the SEP at the Powell Fed. The Fed has long been data-driven in its decisions, but the complexities of the post-pandemic economy have led it seemingly to rely on data over forecasts. Powell even admitted as much at the press conference. Claudia joins us now for more. Claudia, welcome to the programme and a very happy new year to you. It's good to see you once again. How is this complicating decision-making on the FOMC?
Well, I think, a real theme of the last FOMC meeting was how much uncertainty there is about the outlook for 2025. And a lot of that comes from policy uncertainty, out of fiscal policy. But, the Fed has increasingly under Powell become very data-driven. And it's hard to believe it, but I think we're actually going to see a year where the data plays an even bigger role. And we already know that can create a lot of unnecessary volatility because it's hard to measure a $30 trillion economy in real time with a lot of accuracy. So I think we're going to continue to see this real overreaction. And we saw this yesterday with the initial claims for unemployment data to just, these little scraps of data we get on how strong the labor market is, how hot inflation is, so buckle up.
Well, Claudia, this is a reason why people can't liken the moment that we're in to a dark room with a blindfold on, with lots of furniture going around and trying not to bump into anything because the data is messy. We keep talking about distortions, but forecasts have been wrong. And the whole concept of transitory is a huge scar over this Fed. So is there a forecast or an economic model that they should be following? And I'm asking you of the Sahm rule, who has come out and talked about how every rule has its exceptions and it's difficult to really come up with these.
Right. Yeah. This is the past 4.5 years have not been kind to rules or rules of thumb or how it's usually in the past. But we also can't become hamstrung by a mistake or a misjudgment that was made in 2021 about inflation, right? We have moved forward, and we've seen the economy slowly over time heal. We're seeing patterns that make a lot more sense than they did in the early days of the post-pandemic recovery. So the Fed, yes, and that's exactly how it feels. In a dark room, moving, we know there's furniture, but part of the Fed's job is to help turn the lights on and at least chart a path. And yes, that could mean redirecting, but to just, well, what we do this next year, it's going to be all about the data points we get. That really sets up, I think, a lot of unnecessary volatility. Like the Fed is injecting volatility because it's saying, just follow those data points. And we know we get bounced around by them. So you need to have a grand plan in terms of how you're working your way through the year. It's tricky. Like the policy uncertainty is real for this year and for the Fed. So I'm not saying like I have an easy solution for them, but now is not the time to back away from some of the forward-looking, the heuristics that we have.
Mohamed El-Erian would agree with you. He's talked about this as much, the whole over data point dependence. What patterns are you observing that you think are going to be important and prescriptive for what's to come in the U.S. economy?
All right, so I keep all eyes on the labor market. I think that's such a linchpin to the resilient economy we've had and the ongoing recovery, in addition to, millions of Americans' lives really depend on their paychecks. And this is one where I worry that the Fed is somewhat complacent. I think they're being hypervigilant on inflation, as we know the Fed often is and should be. But their outlook that most of the officials laid out in the last number of economic projections is a pretty optimistic one on the labor market, and basically saying, hey, we're back to normal. We're back in, I think Mary Daly even used the word kind of an equilibrium. We got one vacancy for one unemployed worker, and it's close to what the Fed thinks the long run unemployment rate is. And they project that to stay with us. Like, hey, we've got back to equilibrium. We got back to a good place. We're going to stay there. And I think there's a lot of other dimensions you can look at the labor market, particularly the differences between the hiring and the firing. The hiring doesn't look so good. The firing looks really pretty great. Like that's not typical for a labor market, that's in balance, that's in equilibrium. And so I think there are some signs, and that's what we have to keep an eye on, or the places where it doesn't make sense. And another big piece is we've had a big push from the increase in labor supply from the immigration into this country, which has been extraordinarily high in recent years. And that's turning. Even if we don't have mass deportations, we're not going to have a big push from the outside immigration. And that's been an important dynamic of the labor market. We're going to watch it unwind. So I don't think things are as calm in the labor market as the Fed kind of in their latest projection seems to view it. I mean, we're going to get our first taste of the data next week with the report.
Payroll's coming on January 10th. Just quickly, Claudia, how unusual would it be for unemployment to stabilise at these levels after coming off the lows to the extent that they have?
It would be very unusual to stabilize and hold in this place for like the next 3 years, which is essentially what the Fed is projecting. But that's saying that we're in a good place and we're going to stay there. But there is a sense that, barring a lot of this policy uncertainty this year, 2025 really could be, it still could be, but it was on path to be we get to the sustainable place. We work out some of the last disruptions. So we'll see.
I hope you're right. Claudia Sahm of New Century Advisors. Claudia, appreciate your time. Thank you. I think we all hope Claudia's right, because that would be absolutely fantastic if we could stabilise at these levels.
It is people's lives, and that is the reason why it is such a dominant indicator that we will be getting next Friday, not this Friday.
The payrolls report a week away. In our survey, the median estimate 153K. Coming up next in the next hour of Bloomberg Surveillance, Emily Roland of John Hancock, Isa Boltansky of BTIG, Tom Narayan of RBC, and Thierry Wizman of Macquarie. From New York, this is Bloomberg.
We should be seeing a significant rotation into fixed income this first quarter.
We're most worried about higher yields at the really long end.
What do yields reflect? They reflect fear over inflation.
There was this notion of survive until 2025 because Powell is going to bail you out.
There will be a lot more volatility as investors attempt to assess what the Fed will be doing next.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now with equity futures just about positive by 0.2% on the S&P 500. On the Nasdaq 100, higher by 1/3%, following a 5-day losing streak on the S&P and looking to snap that this morning. Yesterday morning, we were looking to snap it too, and then we did not, thanks to better than expected jobless claims data, pushing yields just that little bit higher. Then you had Apple down on the session and Tesla getting hammered as well.
Yeah, the mainstays of some of the rally not performing, and it shows two things. It shows, A, that yields are becoming more important, and that when yields go a little bit higher and suddenly you don't get a bond rally, that's going to have more of an effect on risk assets. And then it just shows a lack of breadth in the fact that a couple of names, big names in the index, can drag everybody else down if they report some news that is less than savory.
Making some headlines in foreign exchange as well, some big headlines in the past 24 hours. So let's start with two currency pairs. The one, euro-dollar, the other, dollar-China. Euro-dollar, a breakthrough 103 to 102 for the first time since 2022. Some real euro weakness and embracing perhaps some Chinese currency weakness by Chinese authorities. Dollar China through 7.3 for the first time since 23.
And reports that maybe Chinese authorities are actually not unhappy about this. You have to remember this is a managed currency, so they have allowed this to happen at a time where they have overcapacity and they're looking to export goods. A cheaper export rate is probably positive for the Chinese authorities. Question now is the U.S. going to be the ones buying, or is that going to be some sort of weaker currency that's exploited elsewhere around the world?
We've got a lot to talk about this hour. Your next 60 minutes looks like this. Emily Roland of John Hancock as stocks look to snap a 5-day losing streak. Isaac Boltansky of BTIG looking ahead to the House Speaker vote. And Tom Narayan of RBC on Tesla's disappointing deliveries. We begin this hour with stocks steady after a rocky start to 2025, looking to snap the longest losing streak going all the way back to April. Emily Roland of John Hancock saying heavy is the crown of US large cap stocks as we kick off 2025. The magnitude of outperformance in 24 is not likely to be replicated. Emily joins us now for more. Emily, welcome to the show and Happy New Year. It's good to see you as always. Do you believe that this move in bond yields, this move in foreign exchange is beginning to hurt risk assets?
Yeah, John, we do. You know, you look at the leadership that we've seen across U.S. assets and, you know, the stronger dollars is something that could be a self-limiting dynamic here. You look especially at S&P 500 companies, 40% of the revenue of large cap companies comes from abroad. You're also seeing, as you mentioned, weaker currencies from other countries making their exports more competitive. Higher bond yields are typically associated with a stronger dollar as well. And you're seeing borrowing costs quite elevated. Mortgage rates now over 7%. Borrowing costs with credit cards are about 20%. Probably shouldn't mention that right after the holidays. But borrowing costs for both businesses and consumers are elevated here. In order for earnings to see these double-digit estimates that are being baked in right now, you probably need to see bond yields come down a bit here. You probably need to see that cost of borrowing, again, sort of become a little bit more mitigated here.
Emily, there is a risk that this continues, and a risk that both bonds and stocks continue to get hurt. And this was a risk that I think Torsten Slock of Apollo really presented going into year-end when he wrote, for investors, the risk is a repeat of 22, where the 60-40 portfolio underperforms significantly, where bonds and stocks get hurt. Do you think we're lining up for more of the same in 25?
Yeah, I think if we do see inflation continue to be sort of enemy number one here, we started to see inflationary pressures pick up towards the end of the year. The shelter component's one we've been watching closely. And while that came down a bit, we saw other elements of inflation actually starting to accelerate once again. So that could be a challenge for yields. That could cause a stronger dollar environment. And it's coming at a time where we just experienced one of the best 2-year stretches for markets in history. This was the fourth time ever that we saw back-to-back 25+% returns for the S&P 500. If you look back, the last time the third year was over 20% was in 1999. So we're going back to the late 1990s if we want to see a repeat of that. We're looking at valuations quite optimistic here at 22 times forward earnings. The best we've seen is 24 times, or the most elevated is 24. So there's another 9 or 10% to go until we get to those levels. But certainly certainly I think valuations are an issue here. The starting point, John, is just a little trickier here heading into 2025.
Emily, a number of guests this morning have talked about how bond yields are becoming a limiting factor to equity valuations. As John just mentioned, do you see that as a reality? A question here about whether rates are cheap or whether stocks are expensive. Which will break first from your expectations this year?
Yeah, we think we're likely to actually see rates come in a bit lower here. You know, one thing that we're watching is the Citi Economic Surprise Index. And actually, there's a big divergence right now between disappointing economic data coming in and the 10-year Treasury yield moving higher. Pretty unusual to see a gap this big. Now, of course, the 10-year Treasury yield can be and probably is moving on something other than the economic data right now, whether it's trend following or whether it's, you know, still sort of animal spirits around this new administration and potential pro-cyclical policies that may be implemented. But we expect that gap likely closes here. We're also, again, watching inflation, watching shelter. If you look at mortgage applications, for example, we're starting to see some weakness there, even with seasonal factors taken into account. So we do think that we could see this sort of impact where the 10-year Treasury yield does catch down along with those disappointing reads on the economic picture.
Doesn't this just support risk assets at a time where everybody is bullish and everyone's looking for an excuse to buy?
Yeah, I mean, certainly, I think equities will respond positively to rates sort of calming down here a bit. And you may be seeing a little bit of that here this morning with rates coming down. You know, we do think that, you know, you could see continued strong returns out of areas like quality stocks in the United States. We like still areas with great balance sheets, lots of cash. Quality is sort of mostly seen in the U.S. large cap space. We still like large caps, but we want to diversify the valuation risk that's there. The S&P 500 growth index trading at over a 50% premium to its 20-year average. So we're leveraging areas like U.S. mid-cap stocks, which are trading cheap. They're benefiting from onshoring activity. You talked about some of the challenges in China. Earlier this morning, there was discussion about energy challenges in Europe. We see the manufacturing renaissance for those reasons continuing in the United States. We like industrials to play that. So it's higher quality stocks in the United States, but finding that quality at a reasonable price, we think is the name of the game into 2025.
Emily, what kind of assumptions are you making with regards to policy on the sequencing and the priorities from the incoming administration?
Not many. We still think that there's a lot of conjecture going on. A lot of the negotiations are a starting point. So we try, John, not to overemphasize politics in making investment decisions. But I think a lot of it has been seen in the sentiment. I mean, it is just amazing to see what's happening in crypto and crypto-related assets. We saw $1.5 trillion in market cap added to crypto markets in 2024. There are, you know, made-up crypto coins that are not ladylike to say, that have a, you know, bigger market cap than 40% of stocks in the United States right now. We would suggest investors fade the sort of speculative frenzy that we've seen in crypto and crypto-related assets and redeploy those assets into higher quality stocks. Look at the backup in bond yields as an opportunity to take advantage of the income that's available there as we potentially see a shift here into 2025.
Emily, do you see any evidence at all that that speculative frenzy extends to traditional equity markets, to valuations of, say, the Mag 7?
Yeah, we do. I mean, right now, the top 10 stocks in the S&P 500 make up 40% of the index. That is a historical high. So we want to be thinking about diversifying away from that, looking at value equities, maybe looking a little bit at international stocks. We just saw a massive outperformance. The S&P 500 outperformed the MSCI EFA by over 20% last year. Really just remarkable. The U.S. large cap growth style box handily outperformed every other style box, U.S. and international, by more than 10%. So diversifying that exposure into next year makes sense. Even looking at more defensive areas of the market, dividend-paying stocks, high-quality bonds, we think there's an opportunity to see more breadth across markets outside of that Mag 7 into next year.
Emily, I love how specific that trade is. Take money out of Bitcoin and put it into quality assets. And that's basically actually what we're seeing. I mean, interestingly enough, Bitcoin, this ETF
ETF that BlackRock created just saw its biggest outflow in its history at $333 million. And it does seem like institutions are backing away from that trade. Are you saying this is significant? This is more than just speculators just shifting away from a hot trade from the end of last year, and actually indicates something that has legs in terms of a risk appetite or lack therein?
Yeah, we certainly do think it's significant, again, given the amount of market cap, not only in crypto markets, but all these crypto related assets. Again, there's just been so much excitement, so much optimism. So we think, anytime you sort of see something move up in parabolic fashion, we think that's really the candidate for some potential selling pressure. And I think that's something that could play out. We still want to be exposed to equities, but we want to do it in a more risk mitigated fashion into next year. And that's really where we see that sort of trade or that shift across markets playing out.
Just to go back to where we began, that heavy crown that big tech wears. And I just wonder, are they going to lose that crown this year?
Well, look, we always look at earnings growth estimates, and over time, stock prices are going to follow profits. And if you look at the U.S. technology sector, it's expected to see about 23% earnings growth this year. So these companies are making money. They've got great balance sheets. They have a lot of cash. We think it's just about looking underneath the hood and choosing which technology companies you like. We prefer the sort of classic S&P 500 technology sector over areas like consumer discretionary, where you're going to find, other names that have run quite a bit for trying not to identify individual stocks. But we do think technology can continue to show fundamental support here, but want to diversify from that and own other pieces of the broader market into next year.
Emily, it's good to see you. Plenty of conversations together ahead in 2025. Emily Roland there of John Hancock on back-to-back 20% plus gains on the S&P 500. Just a programming note, Ed Yardeni joining us later on this morning in the next hour. He thinks you could get a third year of maybe 20% plus returns on the S&P 500. Look out for that. With equity futures right now just about positive by 0.2%, with an update on stories elsewhere this morning. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Israeli Prime Minister Benjamin Netanyahu is sending a delegation to Qatar for Gaza ceasefire talks with Hamas. No timing for their travel was given. Hamas said its delegation concluded a round of talks with Egyptian mediators in Cairo yesterday. Israel last sent a delegation to Qatar last month to reestablish relations with mediators. Citadel has offered the clients the option to cash out profits after a roughly 15% gain in its flagship strategy last year. But the vast majority opted to keep their money in the multi-strat hedge fund. Bloomberg sources say only about $300 million out of billions of dollars in profits were redeemed. The vast majority of high-performing hedge funds aren't taking new money, causing more investors to stay put where they already are. The AP reporting that Apple will pay $95 million to settle a lawsuit accusing Siri of eavesdropping. The suit in California alleged that some recorded conversations were shared with advertisers. Plaintiffs said their mentions of certain sneakers, restaurants, and even surgical treatments triggered ads for those products. Apple isn't acknowledging any wrongdoing. And that's your brief. John.
Danny, thank you. It's everything everyone always thought, right? That your phone was listening to you. You said certain things and all of a sudden you saw a commercial for it.
Yeah.
An advert somewhere.
It actually explains why I've been getting so many advertisements after my kids' discussions about dark chocolate with raspberry and cookies with certain types of marshmallow filling. It all
started popping up on the phone. Is that what happened?
Just saying, theoretically.
Blaming the kids again for that.
Always.
Equity futures on the S&P, just about positive. Up next on the programme, fighting to keep the Speaker's gavel.
We have to stay unified. We'll have maybe one no vote, I think. I think we get it done on the first round. I think everybody understands clearly the mandate that we have, the importance of the moment, and I think they're going to come and get along.
That conversation up next, live from New York City this morning. Good morning. You're waking up this morning wondering if it's Payrolls Friday. It's not. We're easing into 2025. Payrolls Friday is next Friday, apparently. What's that about? We're here. Shouldn't they just drop the number at 8:30 Eastern Time?
I was about to say we is doing a lot of heavy lifting. The government decided that it would give everyone the day off, but not really, because you're still here, but you can't discuss payrolls because that's coming out in a week. I wish that they would actually have it. This is my unpopular decision. I think that they should have it on January 3rd next year, the first Friday of the month.
Agreed. It's what it should be. Feels right. This feels wrong. 153 is the estimate in our survey for next Friday. The previous number, of course, was 227. Equity futures right now in the S&P attempted to bounce. We're up by 0.2%. The move in the bond market muted. Yields lower by a single basis point, 454.51. Yesterday, foreign exchange. Anything against the US dollar in G10 basically cratering, including the euro. Euro dollar breaking through 103 for the first time since late 2022. At 102.96, we're bouncing back by just a third of 1%. At the surveillance this morning, fighting to keep the speaker's gavel.
We have to stay unified. We'll have maybe one no vote, I think. I think we get it done on the first round. Certainly hopeful for that because, as we noted, we've got to stick together. I think everybody understands clearly the mandate that we have, the importance of the moment, and I think they're going to come and get along. Look, I'm a proven fighter. I'm a MAGA conservative, but I'm also someone who can get everyone in that broad array that we have in the House GOP to work together.
So here's the latest this morning. House Speaker Mike Johnson hoping to win re-election with just one ballot today. He's earned President-elect Donald Trump's endorsement, but faces pushback from some hard-right Republicans. Just a couple of holdouts could derail his ability to hold on to the gavel. Joining us now to discuss, Isaac Boltansky of BTIG. Isaac, Happy New Year, sir, and welcome to the programme. Can we avoid another mess down in Washington?
Oh, it's going to be nothing but messes, John. I mean, that's the reality here. When you have such a wafer-thin margin in the House, this is the way that it's going to be all year. I truly think that Mike Johnson is going to retain the gavel. I think it might take 2 or 3 ballots today, but ultimately there's this overarching sense of urgency among the Republican caucus, and I think that that's what's going to drive them to ultimately give Mike Johnson the gavel again. There is no viable alternative to Mike Johnson right now. You're not going to get someone who's more conservative. And really, they just need someone who can make it so that the trains run on time and they can get moving on reconciliation, which is the whole ball game in town this year.
Which is something you're bullish on. I think we should point that out. Isaac, you wrote repeatedly going into the end of the year and into the new year that you're bullish on one large reconciliation package. Given the politics and the margins are very small, what can you point to that gives you the confidence that we can get something big done?
Yeah, failure isn't an option. That's really it. I see it being difficult. Legislating's always difficult with these margins. It's going to be a storyline where I think it's going to die a dozen deaths before we finally get a package. It's going to be that type of thing. But ultimately, I believe that this Congress, with Republicans controlling both chambers and the White House, is going to be able to extend the Trump-era tax cuts by and large and to add on a handful of other items. I think that they realize that this is a window, this is an opportunity, and ultimately you don't get the trifecta that often, and you have to seize on that when you do have the trifecta.
Just to talk about how narrow the margins are. Right now, it is 219 in the House, Republicans versus 215. You look back to 2016, that Republican majority was 241 to 194. So a very different scene for Donald Trump. A question also about what his endorsement means. How much is that really what's going to be tested today with some of the rounds of votes that you're expecting?
Yeah, and look, we saw part of this with the government shutdown drama from the end of last month, is how much does Trump's voice matter here? And ultimately, I think that voice is going to have a say in the caucus. And I think that he's going to be able to get on the phone and get a few of these potential holdouts to vote present, or maybe even just take a walk, so that you change the calculus in terms of how many votes you need from Mike Johnson to get the gavel. Ultimately, I don't think that Mike Johnson is going to be the speaker at the end of the year. I think that he is going to win the gavel this weekend. I think that's going to be necessary in order to certify the election and start moving on reconciliation. But I do see the debt ceiling coming back in the middle of the year as being something that I believe could ultimately cost him his job, and something that I know all of us in the markets are watching, even though we've sadly seen that movie time and time again.
Isaac, that's a pretty bold call that Mike Johnson is not going to be Speaker at the end of this year, but that there will be a Reconciliation Act. I mean, this to me is sort of a squared circle. Can you put it together to understand how this will be an effective Congress, an effective Republican caucus at a time where they are likely to lose their leader by the end of the year over a fight that percolates out?
Yeah, look, I think that we're going to rely a fair amount on the Senate here. I think that one of my governing frameworks here is that ultimately what can get through the Senate, I think, is going to be accepted in the House by the Republicans in the House. And I think that's one of the ways that we're sort of setting our mental model for 2025 is what can actually get done in the Senate. And so I think that that's where I'm looking more and more for leadership on Capitol Hill. I think the Senate Finance Committee is going to be the most important committee in Capitol Hill this year for that reason. And it's one of the reasons that I continue to highlight to clients, it's going to be volatile. It's going to be iterative. But again, failure just doesn't seem to be an option here for Republicans when it comes to extending the Trump-era tax cuts. And so that's what informs our baseline. Well,
Isaac, baseline then, that's $4 to $5 trillion just to extend those tax cuts. The Tax Cut and Jobs Act of 2017-18. Isaac, with that in mind, how much bigger is the number going to be? How big is the appetite for debt?
I am still shocked that I don't think that the market fully has embraced how much deficit spending I think we're about to do. I mean, let's keep in mind that this debt ceiling, the most recent government shutdown fight, President Trump just wanted to get rid of the debt ceiling altogether. I think that tells you a bit about how he's thinking about the coming year. We also have the Senate Finance Chair, Senator Crapo, talking about using a baseline where they just assume all of the Tax Cut and Jobs Act provisions are extended. So saying we're not spending money, even though they're spending $5 trillion. So look, I think that we're going to have $6 to $7 trillion in deficit finance spending come out of this Congress.
Do you think we're underestimating the extent to which they're willing to use tariffs as a way of offsetting some of that spending?
Yeah, look, and this is something I've heard from making the rounds on the Hill over the past few weeks is I think that there's going to be a lot of talk about tariffs and a lot of counting of future tariffs against this. I think that they're going to be really some gamesmanship, as there always is with budgets, around how much they're going to, quote unquote, earn from tariffs. And they're going to try to count some out-year tariffs as well. Because there's still an awareness there that they don't want to front load the tariffs because of the economic impact. So is there a way that they can say, maybe we'll count, expanding tariffs in years 3 through 10 as a means of being a budgetary offset? So I think we've just got to keep our head on a swivel because there's going to be some pretty ridiculous budget gimmickry that we're going to see over the next few months.
And this is going to be gripping, that's for sure. Must-watch TV. Isaac Boltansky of BTIG. Isaac, thank you. We had this conversation yesterday with Stuart Kaiser of Citi. What year are we going into here from a policy perspective? 2017 for markets, low volatility, everyone thinking about tax cuts, or 2018, Volmageddon, tariffs, and then Fed policy got dicey as well by the end of that year.
Yeah, and you start to ask the same question that everyone's been asking, sequencing, right? What do you get in terms of sequencing? I just wonder, as I'm listening to Isaac Boltansky speak, maybe this is why real yields are as high as they are, because they're sniffing out deficit spending and that potential volatility that comes with the expectation of tariffs to pay for all sorts of stuff that is getting priced now, even though the tariffs aren't going to come until 2046.
$4 to $5 trillion just to extend TCJA. I mean, these are serious numbers.
I love the gimmickry that he was talking about. I will say with the debt ceiling limit, there was a fantastic article by David Malpass in the Wall Street Journal over the break. I highly recommend people read it. It was about why it's a fallacy.
We'll get David on the programme sometime soon to talk about it. Equity futures right now on the S&P up by 0.2%. Tesla in focus. Up next on the programme, we'll catch up with Tom Narayan of RBC as Tesla's annual EV sales drop for the first time in more than a decade. Equity futures bouncing back from 5 days of losses on the S&P 500. We are higher by just 0.2% on the S&P. On the Nasdaq 100, inching higher as well, up by 0.3. With 2 hours until the cash open, let's get you some morning movers and say good morning to Manus Cranny. Good morning, Manus.
Jonathan, very good morning. Maybe the real money turns up next week. Either way, U.S. steel is under pressure. What will U.S. steel become if, as we understand it, the Nippon bid is blocked by the Biden administration? Nippon pay over $500 million in a slice-off fee. But what can save U.S. Steel? They have 11,400 employees. JPMorgan says that this company has a strong standalone valuation, but they're going to have to make some very tough decisions. Downsizing perhaps the old furnaces, cutting jobs, closing plants, moving the headquarters from Pittsburgh across to another centre. These are all the issues that are going to face U.S. Steel at the moment. No deal for steel, and it looks under pressure. Roll it forward, have a look at Stellantis. In Europe, you're seeing car production in Italy down by 46%. 46% drop in production there. Here in the United States of America, we know there's a debate over access to those credits for EVs, but it's going to become tougher for hybrids, and the access for Stellantis and others, VW, it's going to get tighter. And this is about domestic sourcing. So next week, the rules change. Stellantis, part of their production line, loses access to the credits. Then you move to the much bigger debate for 2025, those bigger EV credits and who survives. Now, when it comes to dog food and pet food, no, I haven't got a dog, but this is a tail wagging 2025. I love that tagline from Wolfe Research. Price target $42. Look after the doggy. Look after the dog. Never mind your health. Never mind your teeth. Look after the dog. Price target $42. 24% upside. Sales growth is underestimated in the market. I like that, Jonathan.
Never mind
tail
your
wagging
teeth.
2025.
Never mind your teeth. Where's this going?
The teeth are good. The teeth are good. For a European, the teeth are good.
Your teeth look great. Manus, thank you.
Thank you.
Stock is up by 2.6%. Never mind your teeth.
Well, why is it one or the other? Why does the dog have to get fed instead of my teeth having some good care?
I think we need a conversation with Manus after the show, a little bit later this morning. On the surveillance this morning, President Biden is set to block Nippon Steel's $14 billion takeover of U.S. Steel. Sources telling us here at Bloomberg the White House will announce the decision later on today. Manus went through the stock move. We're down about 8%. Elsewhere, I wanted to talk about this story. I think we all did. Meta Global Affairs President Nick Clegg stepping down. He will be replaced by his deputy, Joel Kaplan, a prominent Republican voice at the company who has argued forcefully against political speech restrictions. Clegg was a strategic hire back in 2018 thanks to his time and experience in European politics and led Meta's lobbying efforts.
Yeah, so Nick Clegg previously was the leader of the Liberal Democratic Party over in the United Kingdom. He ended up as deputy prime minister under David Cameron, a real kind of unity person, and who actually probably was tainted because of some of the compromises that he ended up making. A real shift, though, given the fact that that was considered the lobbying effort that was most crucial for Meta at the time, given some of their challenges and some of the hacks and things that have happened. Now, Joel Kaplan, who is a prominent Republican, he was the advisor, he was the deputy chief of staff to President George W. Bush, raises this question of how much they are putting on the front burner the importance of lobbying President-elect Donald Trump, and how much of a shift of tone that really will be for this company in terms of content, in terms of moderation.
There's so many different angles
yes, there are.
to all of this. There's a regulatory angle. I also think there's a consumer angle as well. On the regulatory angle, for a long time, these major tech firms have cloaked themselves in liberal values because they were afraid of the regulatory impulse of the left. And I think they're waking up to reality that they also need to be equally afraid of the regulatory impulse of the right, which is why you're seeing shifts like this. But I'd extend this conversation to the consumer as well. We've seen this at Target, at Budweiser. The most important business lesson came decades ago from a basketball player, and it was Michael Jordan. When Michael Jordan turned around and said, Republicans buy sneakers too. We've talked about this before on this programme. These companies have woken up to a more, I would say, assertive, conservative consumer at a time where we've had much of the last decade catering towards just the consumer on the left. Now they've got to wake up to that too. So the winds are changing all over the place. And I think it's a really interesting moment for business.
I would agree. I think that the business of social media, though, is unique in terms of how do you create an honest to goodness town square? How do you create real discussion with open conversation where people actually are not just stuck in echo chambers? That is going to be a challenge for some of these potential platform owners, given the fact that we've seen that time and time again. Is it going to be a pendulum that shifts from one side to another, or do you just basically make it a free-for-all? How do you do this has been one of the quagmires they've been grappling with.
I think companies went too far in one direction. And we saw, particularly following the election, that many of these companies are offside with the centre of gravity in the country. I think many of the CEOs that run these companies find them offside with the centre of gravity in the country, and as a consequence, maybe even offside with the centre of gravity inside their own company. So you think about a range of initiatives, whether it's DEI, whether it's climate change, all of those things, you're beginning to see shifts on those fronts as well. So for corporate executives, they've got to confront a whole range of issues, particularly post-election in this country and beyond.
Can they afford to stay out of it? And the answer is probably not if you have President-elect Donald Trump who wants to be catered to. And that, I think, is maybe what we're seeing with this latest move from Meta. I think it's a larger conversation. I think that there is a question also about whether individual industries are going to have to face this in a different way, whether it's moderation or whether it's the products that you sell in a store.
That's certainly the latest on the tech front. Let's turn to this one. Tesla's Cybertruck will now qualify for up to $7,500 in US tax credits, part of a reshuffling that disqualifies other EVs for federal subsidies. The change coming as part of President Biden's Inflation Reduction Act, tightening domestic sourcing requirements for battery parts and raw materials.
I'm sure that this is incredibly environmentally sound. It just highlights this question around what the goals of some of these subsidies are. What's fascinating to me, okay, this is a subsidy that was meant to produce both some support of American vehicle makers as well as electric vehicle makers. Who are the ones that benefit from this? Right now, you have some that are getting taken out of the subsidies. You have the Cybertruck being granted this. You have cars from Hyundai and Kia who have the right sourcing agreements to be eligible for these EV credits. It just sort of goes to the question of what are the actual accomplishments of some of these programs versus the goals and the discrepancy there.
Yeah, and how environmentally friendly are some of these vehicles that are being produced?
That Cybertruck is, I'm sure.
My goodness. OK, we'll get back to this story in a moment, but let's stick with Tesla. The EV maker's annual vehicle sales dropping for the first time in more than a decade. The company also recording its first ever drop in annual shipments from its Shanghai plant. Joining us now to discuss is Bloomberg's David Welch. David, welcome to the programme, sir. It's an interesting moment for this company because really the analysts were caught off guard by the company itself at the end of last year, really boosting the forecasts around auto sales. What went wrong here?
Okay. Tesla's just hitting a point where their market for selling EVs, and I'm talking globally, is very mature, and they've got a lot of competition. Past few years, when we've seen these meteoric growth rates from Tesla, there was good competition in China, but it was still ramping up, and there was almost no real competition in the U.S. Yes, you had Ford with the Mach-E and the Lightning. GM wasn't in production in earnest. Hyundai and Kia were just kind of getting started, and nobody else really had much. Now you've got almost a dozen models out there from General Motors. You've got a pretty good number from the two Korean brands. And, that's posing real competition for Tesla. And really, you mentioned the Cybertruck earlier. Tax credits will help it, but it's a niche product, right? It's still pretty expensive. It's obviously, to a lot of people, pretty strange looking, not a mass market vehicle. So really, Tesla's lineup has had 4 of the same vehicles for, going back a decade now with the Model S that kind of look the same, haven't had major overhauls in design or styling. The cabins aren't super luxurious or nice. They haven't changed much there. The technology's gotten better, but the lineup hasn't been freshened. So you kind of get a leveling off in sales at a time when the competition is tougher. China's going to be very tough for them to get market share because of BYD and the domestic automakers over there, not only subsidized, but having some great technology and great products as well. So it's just really tough for Tesla to continue growth and gaining market share without expanding the lineup. And I think that's what Elon Musk is really talking about. You'll have some sort of cheaper Model 2 type vehicle this year. And that's where, if he's going to get some sales growth, it's going to be from that model and maybe discounts on the others.
David Welch at Bloomberg, one of the very best, really pointing out what we've talked about quite a few times on this programme, that this is one of the most competitive industries, the most competitive markets anywhere on the planet, China and autos.
I thought you were going to say pointing out the somewhat strange look of the Cybertruck, which I would say some people say is a feature, not a virtue. Weren't you the one who said it looks like some kid just drew a car in first grade?
A long time ago, when they first released the pictures of it, yes. When they first released the pictures, I said it looked like what an 8-year-old might have drawn if they were drawing the car of the future. And then I saw the order book and the amount of people that wanted one. So I was wrong, and the consumer obviously Proved Tesla's designers right.
Honestly, simple shapes work, you know? That's all I could say. I saw a lot of them in Florida when I was there.
Certainly eye-catching when you see them driving down the road. Tom Narayan of RBC's with us now. He's got an outperform rating and a view on the Cybertruck. An outperform rating on Tesla with a 313 price target. Tom, good morning and Happy New Year. It's good to see you.
You got it.
What went wrong yesterday?
I think we're what happens every quarter. We go too into the detail and the weeds on these numbers. Let's just take a step back. They did 496. Consensus was at 508. Buy side, I think, was higher at like 520. And people were looking at the monthly data. The first 2 months of the quarter were actually pretty strong. We have Europe and China data, which wasn't that bad. Let's remember, they don't produce as much in China anymore because of the tariffs, because they sell a bunch into Europe. So, you know, in the grand scheme of things, I actually had a 496, so they actually didn't miss my number. Just saying. But I think the expectations was just a little high. You know, this year, I keep forgetting, it's 2025 now, we're going to have this new model, right? Whatever they call it.
Sure.
And I don't know, what if it looks like the Cybercab, which a lot of people like that aesthetic. I don't think that looks anything like the Model 3 or the Y, you know. So it's for the first time, as your colleague said, in years, you could get something that looks different, that is different, and most importantly, price different. You know, the biggest critique that people have when buying an EV now isn't really range anxiety anymore. It's price. They're too expensive. What happens if we do get a lower priced car? So I don't know. I tend to think this is just an expectations miss as opposed to something that we should be worried about.
What's Tesla's secret for being able to sell into China at a time where there's increasing divergence for every other company?
Yeah, I mean, they have the software. Remember, that was the issue the German OEMs have, especially Volkswagen in China. The number one thing the Chinese consumer wants isn't necessarily like your 0 to 60, your speed, or even driving performance. It's the software, it's connectivity. That's probably the biggest feature. And there is a tech halo effect. You know, I talked to a lot of investors in China, and they say basically like the German OEMs kind of lost their luster. It's kind of like my dad's car. But Tesla still gets that halo effect of being youthful. If you look at the kind of the wealthy consumer in China, they tend to skew younger than in Europe and the US. So I think that probably helps. It's kind of tech halo effect.
Well, I guess what I'm asking is, there's this real tension right now developing, and Elon Musk is such an interesting character because he's both a lobbyist to the president, or direct voice to the president of the United States, while also being a major presence in China. How does he become sort of the Tim Cook, the sort of ultimate diplomat where he maintains his place while there's an increasingly hard line, ostensibly, from the Trump administration?
I mean, he's been able to do it. I mean, the German OEMs had to do a JV, you know, with the Chinese players. Tesla didn't have to do it. They were able to negotiate and sell directly and produce locally there. The other thing, and I think this will become more and more important as the year develops, is FSD. I encourage both you guys to try it if you haven't already. And, you know, Elon talks about getting approval in Europe, but also China. FSD is a game changer. It's now hands-free in the US. If that holds on and we don't have a competition in China for something like that, again, tech, that's really, at the end of the day, people are going to buy the product if they like the product, regardless of the politics.
Is it a winner takes all if a Waymo comes out and does it even better? And ultimately, they are doing it quite well. Is it a winner takes all?
No, definitely not. No.
Why is that not the case?
This is such a big market.
Yeah.
I mean, the robotaxi market, I guess is what you're talking about, will be, you know, I've seen forecasts up to like $10 trillion potentially at some point. There's so many players in this. Now, is it going to be a lot of software players? Maybe not. Maybe it's only a handful. But I mean, at the end of the day, as long as you have the service in operation, it's not winner take all with Uber, right? You have Lyft, you have Bolt in the UK, you have others. There'll be multiple players, but the quality, the cream definitely will rise to the top, and you'll have fewer of them.
So I've got some questions as well about how to value the company. And
Okay.
it's difficult because it's certainly got the multiple of a growth company, but the underlying business hasn't provided the growth. And that's been true for quite a while.
Sure.
So if that was your view on the stock for the last 12 months, you certainly lost money and didn't make it because you were on the wrong side of the trade. What is driving this stock? Yesterday it was vehicle sales, and for the most part of the year it hasn't been vehicle sales. What drives this name? What drives the multiple?
Yeah, this is clearly a narrative stock. I mean, it's up, 35% since the election. Yesterday it pulled back, 5%. So I think a lot of yesterday's move was just more of taking profits.
An excuse to sell.
An excuse to sell, exactly. Like I said, it wasn't really that bad of a number. I think the valuation is based on narrative. It'll be based on this new car that we see this year. It could be based on FSD. What if they just cut the price to $50 a month from 100? All of us will buy this thing, right? And now your multiple re-rates because it's an autonomy stock. I mean, there are things that could happen that change everything. It's also a narrative, even though I don't think this should be viewed as a massive catalyst, but what if there's regulatory federal dereg of self-driving, right? That's a narrative piece. You can put a huge valuation on autonomy. So I think it'll be news headlines like that, and it could be something with this new car or FSD take rates increasing.
Got a lot to talk about in 25. Tom, it's good to see you.
Got it.
Tom Narayan there of RBC. The stock is bouncing back by just 0.1%. With an update on stories elsewhere, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. The Biden administration is weighing rules that could limit or ban Chinese drones in the U.S. over national security concerns. The Commerce Department is seeking comments with a March deadline. That would leave any final decision to the incoming Trump administration. U.S. lawmakers say two Chinese firms, DJI and Auto Robotics, control 90% of the global drone market. President Biden is awarding 7 former U.S. Army soldiers and 8 public safety officers presidential medals. Veterans of the Korean War and the Vietnam War will receive the Medal of Honor for going above and beyond the call of duty. Members of the Nashville Police Department and 2 New York City firefighters are among the recipients of the Medal of Valor for their courage. Rolex has raised prices on some of its models after gold's value surged last year. Some of its most popular models, like the yellow gold Date and GMT Master, are 8% more compared to last year. The Swiss watch brand typically raises prices once a year on January 1st. Price changes usually indicate demand, material, labor costs, and inflation. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the programme, the yuan under pressure.
We think the path of kind of least resistance, so to speak, is for dollar CNY to continue to move higher. Our forecast for this year sees dollar CNY moving up towards the 750 level. But to be honest, the risks are very much that we could see an even bigger move lower for the renminbi this year.
That conversation up next, live from New York. You're watching Bloomberg Surveillance. Equities at the moment bouncing back by just 0.2% on the S&P. Lots of attention in foreign exchange. The euro bouncing back to 103, just about holding on. That currency pair up by 1/3%. Under surveillance this morning, the yuan under pressure.
The messaging that we've heard from the leadership in China has signaled very clearly that they're going to be more proactive, both in terms of fiscal policy support this year for growth, and at the same time adopting a looser policy stance for monetary policy. The path of kind of least resistance, so to speak, is for dollar CNY to continue to move higher. Our forecast for this year sees dollar CNY moving up towards the 750 level. But to be honest, the risks are very much that we could see an even bigger move lower for the renminbi this year.
So here's the latest this morning. China allowing the yuan to weaken past 7.3 per dollar for the first time since 2023. The move signalling the PBOC may be looking to accommodate mounting growth pressures through a weaker currency. Terry Wizman of Macquarie joins us now for more. Terry, good to see you.
Good
and
to
a
see
happy
you,
new year.
Happy New Year to you.
Is China embracing the weakness?
I think so, and I don't think this was a surprise, to tell you the truth, in view of the fact that they have kept interest rates very low, now at 1.5%, unattractive rates for foreign investors, but also for domestic investors. It seemed inevitable that there would be upward pressure on the dollar, downward pressure on the yuan, and that eventually they would meld a willingness to allow the yuan to depreciate with their overall economic policy of stimulus. There are 3 prongs to the stimulus: fiscal policy, low interest rates or easy credit, and inevitably a weaker currency as well. Keep in mind, China has done well to the extent that it has with respect to growth in 2024 because it has maintained strong manufacturing exports. Now it's a threat of losing them, in part because of tariffs, in part because of the slowdown, let's say, in Europe. It has to defend itself against that. It certainly doesn't want growth to fall below 5% in 2025. A weak currency is part of the agenda here to ensure that they get to their growth target.
Will it work? Will it actually generate enough growth to actually make the renminbi attractive again at some point mid-year?
Yeah, I hate to put it in these terms, but it doesn't really depend on China and policymakers in China. It really depends on, to some extent, on what the Trump, a large extent really, on what the Trump administration is going to do with regard to tariffs. Remember, U.S. import tariffs imposed on China can blow up whatever policy ambitions and growth ambitions they have. This is a precursor, if you will, a preemption of what could come down the road with regard to U.S. import tariffs. But if the U.S. import tariffs are aggressive enough, this will implode their plans. The other way their plans could be imploded is if there's capital flight. If they signal to the market, or in an unsure way, let's say, or an undecisive way, how much they are willing to let the yuan depreciate, you could see flight out of the yuan. You could see capital flight. It could derail investment plans in China. It could make the cost of capital for private capital higher as a result because they're not getting the capital in flight they want. That could also derail growth. So there's a balance here. You want to allow exports to become more competitive, especially in the face of U.S. imports, but you don't want capital to become too expensive either.
There's a broader question here, especially as we see the dollar appreciate versus basically everything. It's not just a UN story. Is there a breaking point where the dollar becomes too strong? Is there something that you're watching to really understand whether there's sort of a self-limiting characteristic to some of this rally?
There really isn't a self-limiting characteristic to the dollar, with the possible exception that U.S. export balances, the current account deficit in the U.S. gets too wide, and people lose confidence in the ability of the dollar to continue to strengthen as a result of that, because there are too many, there's too much flight out of the dollars through the trade balances. But I would say that this is a narrative that is going to continue into the early part of this year. And what I mean by that narrative is the U.S. exceptionalism, or the American exceptionalism narrative. And it's not just about better growth in the U.S. It's not just about higher interest rates in the U.S. It's also about the U.S. asserting itself geopolitically and strategically. This Trump doctrine, or this Trump corollary to the Monroe Doctrine, if you will, where the U.S. wants to expand its presence in the Western Hemisphere. The rest of the world sees this and sees a reassertive U.S., and it looks at this and it sees other countries unable to assert themselves geopolitically. And of course, this is good for the dollar. People want to be in strong countries, not strong economic countries, but strong political countries as well.
Where does this leave Europe and a single currency?
Well, somewhere in between. I don't think that the U.S. is trying to effectively dissolve the European Union or destroy Europe. I think the U.S. wants to bring the EU into its political orbit and away from China. And to the extent that Europe needs to weaken a little bit for them to realize that this is where they need to align themselves, so be it. That might be a part of the U.S. strategy. But it's maybe to weaken Europe, if only to strengthen it down the road, by having Europe make that choice. But then again, Europe is not the only economic sphere that needs to make that choice. There are plenty of emerging markets as well that need to make a decision over the next few years who they want to align themselves with. Mexico, Brazil, for example. So Europe is not the only economic zone in this predicament.
Europe has attempted to sit on the fence for a long, long time on this issue.
Well, this is sort of the fear right now in a lot of countries. Do they have to choose? And this goes to the likes of Vietnam and Thailand. But with Europe, it is especially prescient because there is this feeling that they have been this close ally with the U.S. And if that gets called into question and forcing them to choose a side, how do they do that with a lack of leadership at so many places?
The incoming president forcing their hand, that's for sure. Terry, it's good to see you, sir.
My pleasure.
As always, big year ahead. Terry Wizman there of Macquarie on the FX market. Euro-dollar around 103. Up next, Ed Yardeni of Yardeni Research. Sheila Kahyaoglu of Jefferies. Stephanie Roth of Wolfe Research. And we'll catch you with Mark Cabana of Bank of America. The third hour of Bloomberg Surveillance. Up next.
This looks like a time of both opportunity and risk.
The context in which the economy is set up for in 2025 under Trump presidency is beneficial for small, medium, and larger sized companies.
I think that the tech stocks and the tech sector is going to continue to perform fairly well.
I'm a little less concerned about concentration. I mean, I think those companies are performing well for a reason.
We'd expect another strong year
just not to the same extent of 2023 or 2024.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Looking to arrest the 5-day slide on the S&P 500. We're bouncing back by just 0.25% on the S&P. On the Nasdaq 100, we're hard by 0.3%. Hitting the ground running as we kick off 2025 and looking ahead to payrolls Friday, a week today. On January 10th and on January 15th, CPI data. On the 20th, inauguration. And then following all of that, at the end of this month, on January 29th, an FOMC rate decision. If you want a sneak peek, a preview of next week, payrolls 153 is the estimate in our survey, 227 the previous number.
Incredibly important to see what this looks like, especially after all the allegations of distortions of the data because of the hurricane and other sorts of ramifications at the end of last year. A real question about whether we have just seen a blip for the past 5 days in terms of the hiccup in risk assets, or whether this is some sort of forward-looking indicator at a time when so many people still are expecting that labor market to hang in there.
The setup for this year is so different to last year. So different. We came into 24 looking for 6 or 7 interest rate cuts, a fear of a recession. There was a lot of negativity to feed on for equity investors. The bar was pretty low. Coming to this year, sentiment sky high. Investors, for businesses, for consumers. You've got interest rate expectations incredibly low. We're expecting, 1 or 2 rate cuts from the FOMC with a bias to less and not more. Let's see how things change after a couple of data points over the next few weeks.
Just to build on what you're talking about, last year the biggest mistake was that people were too bearish on risk assets and they were too bullish on the prospects of rate cuts. They really overestimated how much higher rates would diminish some of the momentum in the U.S. economy. In the U.S., can we turn that on the head this year, where basically people are too bullish on risk assets and too bearish on the prospect of rate cuts? Or is it going to be more of the same? And are people basically coming around to the reality that this is an economy that will not be deterred by interest rates of 4 to 4.5%?
We'll catch up with a man looking for more of the same. Coming up this hour, Ed Yardeni of Yardeni Research, with stocks on the longest losing streak since April. He's looking for another big year ahead for the equity bulls. We'll speak to Sheila Kahyaoglu of Jefferies on whether Boeing can stage a 2025 turnaround, and Stephanie Roth of Wolfe Research looking ahead to December payrolls. We begin this hour with stocks steady, looking to snap a 5-day losing streak as investors await fresh US economic data. Ed Yardeni of Yardeni Research staying bullish. 3 consecutive years of double-digit gains don't happen too often. Nevertheless, that's what we're expecting. We see the S&P 500 increasing 19% this year to 7,000. However, we think it could be a bumpier ascent than in recent years. Ed joins us for more. In the flesh. Good to see you, sir.
Thank you.
Happy New Year. Let's start with that double-digit expectation for 2025. With some volatility, what's different about this year compared to last?
Well, I think we're starting off with more uncertainty on both monetary and fiscal policies. We really don't know how all these different policies that the Trump administration will introduce basically from day one. I'm sure there's going to be something like 20, 25 executive orders, coming very shortly after the inauguration. The problem is we don't really know how these things are all intermixed. It's kind of like a doctor prescribing a whole bunch of different medications to you and didn't check the computer that some of them don't interact too well. So we'll see how deportation and deregulation and tax cuts and tariff increases and what that implies for the deficit all mixed together. And meanwhile, the assumption is that the Republicans are in a position to get everything through. Well, maybe that's not quite the case. They've screwed it up before. They could do it again, I suppose. So there's a lot of uncertainty on the administration's policies. And then monetary policy is on pause right now. And the question is how long? And I think for a while.
Let's start with the administration. What are the assumptions that you've made, if any, that go into your forecast?
Well, I'm basically acknowledging that I don't know how it's all going to end up, but my gut feel is that when you add it all up together, it'll be an unbalanced positive for the economy. I think the other thing that's important to recognize, especially after the past 3 years' experience, is that the economy has been, as you mentioned, as Lisa mentioned, remarkably resilient to high interest rates. And so we really need, the economy is kind of like the Rodney Dangerfield of all this. Doesn't get enough respect. It's got its own dynamics. It's not totally dependent on what happens in Washington, D.C. And so I think we are going to see a productivity boom, which I think has already started, and that'll keep the economy moving at a faster than expected pace, and that'll keep inflation down.
Do you think that rates then are fairly valued, even though some people are saying actually maybe they're looking a little cheap after the recent rise at the end of last year?
Mm-hmm. You're talking about interest rates? Well, on the interest rate front, I was not in the camp expecting several rate cuts last year. And then at the end of last year, especially around September when the Fed chair started talking extremely dovishly, I couldn't understand that. I mean, the economy's doing fine. Inflation is pretty close to 2%. So what's the need for lowering interest rates? I think I think we are at neutral. I think we are where interest rates should be. The economy is doing quite well with it. And there's a lot of consumers, individuals, households that really enjoy having interest rates at these levels. A lot better than getting nothing for your money market funds.
Which is the reason why so many people have been piling into cash. It raises a question. If we do see a third year of double-digit returns of the 19% gains that you foresee, is that going to be concentrated again in the same leadership, given the fact that a lot of the equal weight, the broadening out types of beliefs really stemmed from the idea of lower interest rates?
Yeah, well, look, I think that lower interest rates certainly help mid-caps, the small and mid-cap stocks. And we had a couple of instances last year where all this excitement about rates coming down got them to do reasonably well. And then it all kind of fizzled apart in December as rate expectations changed. And suddenly maybe the Fed's not going to be lowering interest rates as much. And so, okay, everybody piles back into the Magnificent Seven. But I like the S&P 493. They've lagged behind. And you know, I think when you look at an S&P 500 portfolio, the way I look at it is all the stocks in there are technology stocks. They either make it or they use it. If you don't use it, you're going to lose it. You're not going to be competitive. So I think we have yet to see companies announce and demonstrate that all these technologies that are out there, not just artificial intelligence, but robotics, automation, and just thinking about changing your procedures in a way that makes workers more productive. A lot of that's going on, and we are actually seeing it in the data. My projection that we're in a productivity growth boom is really not so much a forecast as it is an extrapolation. We've already seen a pretty significant pickup in productivity. I think it keeps going.
We'd love your thought on US Steel as well, so hold that thought. We'll come to you in just a moment. US Steel right now, negative in the pre-market, has been all morning off the back of reporting that President Biden would block this deal. Getting confirmation, Biden blocking Nippon Steel's proposed takeover of US Steel. In a statement, the president's saying the following: we need major US companies representing the major share of US steel-making capacity. That is why I'm taking action to block this deal. He goes on to say US Steel will remain a proud American company, one that's American-owned, American-operated by American union steel workers, the best in the world.
This raises the question of how this will be interpreted next year. This seems to be in line with what President-elect Donald Trump was talking about, that he also would block this deal. But it comes at a time where everyone is expecting a whole host of mergers and acquisitions as a result of a loosening in some of those parameters. And it raises a question: what's national security, what becomes political, and what will get through at a time when ostensibly this is going to be an administration more amenable to mergers.
That stock is down in the pre-market by around about 8%. Ed, to bring you back into the conversation, to build on what Lisa was saying, what's the signal you take away from this?
From the steel announcement?
Blocking the deal. To Lisa's point, what can get done, what can't get done?
I guess we have to conclude that the Biden administration is still in business. They haven't closed the shop yet. But it is consistent with what Trump's been pushing for, as you said. And it's also consistent with a regime change in the Biden years and Obama years. I think you could kind of combine those years together. We had a lot of globalization, the idea that America's interests were identical to global interests, and we all had to work together, kind of a kumbaya kind of approach. Now we have, no, everybody pursues their own national interests, and we can talk about it and negotiate and work things out, but, we're going to push for our national interests. You push for your national interests. We'll use our economic power to get what we want and to try to cut back what we have to give in return. And that's kind of the environment we're in right now.
But there's a real tension developing, especially at a time where people are talking about potential external foreign investment in the United States in order to gain a presence here, at a time where people are talking about mergers and acquisitions and the boom that possibly could really lift banks and other financial firms. How do you put that together with a real existential question about what is national security? What is going to be politically viable? Will this administration, the Trump administration, be excited about the idea of tie-ups even in the tech space?
Well, I think that it'll be more laissez-faire than we had under the Biden administrations. Certainly, we'll have more M&A activity. I think it's been going on kind of quietly in the tech field. It's just not public because a lot of the deals are Microsoft buying, a private company. That's one of the frustrations that small cap managers have, is they spend all this time putting together a portfolio of 20 great little companies, and they expect that, only a few of them will become the next Microsoft, and it never happens because Microsoft buys them. So I think there's still there is a lot of M&A going on even now. But I don't think the government's going to be as interventionist as we've seen under Biden.
So you're unabashedly bullish. You do expect this to continue to be the roaring 20s. What is the potential risk that you see out there at a time where we're talking to some people about gold, some people about the possible dissolution of some of the M&A fervor?
Well, you did mention that I'm looking for a bumpy year, and I would say that a lot of those bumps are going to be occurring over the next few months. We certainly have the uncertainty about monetary and fiscal policies. The bond vigilantes, my friends, the bond vigilantes are acting up again, and the bond yields are around 4.5% and getting a lot of questions. Not just only can we go back to 5%, but could we breach that and go to 6%? I wouldn't be surprised if we saw 5%, and that would spook the market on a short-term basis, but I think we'll find plenty of buyers at 5%, just the way we did last time. And then, of course, there's geopolitical concerns. The Middle East is still a mess. We have yet to see what Israel's going to do next with regards to Iran, and what Iran will do next with regards to Israel. So that confrontation is still ongoing, as is Ukraine and Russia. So I think, you put it all together, and at least for the first few weeks of the year, I think there's a potential for the market to weaken, and maybe perhaps even a correction, but I would view that as a buying opportunity.
Certainly weaker over the last week. Ed, it's good to see you, sir.
Thank you.
Should do this more often in person.
Absolutely.
Thanks for being here. Ed Yardeni there of Yardeni Research. Equities up by a third of 1% on the S&P, with some breaking news and a whole lot more with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. We begin with that breaking news. President Biden has officially blocked Nippon Steel's proposed takeover of U.S. Steel, confirming our earlier reporting. The statement from the president follows as thus: "It is my solemn responsibility as president to ensure that now and long into the future, America has a strong domestically owned and operated steel industry that continue to power our national sources of strength at home and abroad, and it is a fulfillment of that responsibility to block foreign ownership of this vital American company." Shares down nearly 8% now of U.S. Steel. U.S. investigators say that there's no evidence linking the deadly attacks in New Orleans and Las Vegas on New Year's Day. There were some similarities, though. Both suspects were U.S. Army veterans who used the same app to rent electric vehicles. The man who drove into a crowd in New Orleans, killing 14 people, had claimed to have joined the Islamic State. An official says there's no evidence, though, that the jihadist group coordinated the attack. Elon Musk gifted 268,000 shares of Tesla to unnamed charities 2 days before the new year. The $112 million gift was part of the billionaire's year-end tax planning and went to what was described as, quote, certain charities. Musk sent over $5 billion to unnamed charities in a similar way at the end of 2021. Those funds went to his own nonprofit, the Musk Foundation. And that's your brief, John.
That's what I want my year-end tax planning to look like. Just giving away 100 mil.
If you have 100 million to give away, it's sort of like all the people who say, I want to grow up and be a philanthropist.
What a world. Very different to ours, that's for sure. Up next on the programme, the Morning Calls Plus, Sheila Kahyaoglu of Jefferies, as investors wait to see whether Boeing can stage a 2025 turnaround. That conversation just around the corner. It's official. Following our reporting here at Bloomberg, President Biden coming out and blocking Nippon Steel's proposed takeover of U.S. Steel. That stock is down by 8% in the pre-market, as it has been through most of this morning. The president saying U.S. Steel will remain a proud American company, one that's American-owned, American-operated by American union steel workers, the best in the world.
Talking about why this is important for the strength of the country, but also saying for too long, U.S. steel companies have faced unfair trade practices as foreign companies have dumped steel on global markets at artificially low prices. This came even after Nippon Steel offered to give the government veto power over any potential production cuts coming out of U.S. Steel. Now the question is, what's next for a company that is going to be seeking some sort of either takeover or a sale of certain parts?
We'll head down to the nation's capital in the next 30 minutes or so and catch up with Bloomberg's Tyler Kendall to talk about some of those issues. That stock is getting hammered this morning. Equity futures elsewhere more broadly attempting to bounce back from a 5-day slide on the S&P 500. The longest daily losing streak going back to April of last year. We're up just a third of 1%. On the Nasdaq 100, we're higher by 0.4. Let's get you some morning calls. Your first call from Wells Fargo, raising its price target on Citi to 110, calling it the dominant number one pick in almost any scenario in the sector. That stock is up by 1.1%. Your second call from Wolfe Research, raising its price target on Meta to 730, citing product catalysts driving upside and a healthy macro backdrop. That stock is up by 0.5%. And your third and final call from Canaccord, raising its price target on Tesla to 404, seeing growth opportunities ahead in EVs, autonomy, energy storage and robotics. That stock is up by 0.5%. Let's turn to Boeing. The FAA saying the plane maker's efforts to improve its manufacturing quality are still in early stages. Joining us now to discuss, Sheila Kahyaoglu of Jefferies. Sheila, good morning.
Good morning.
And a very happy new year to you.
Happy New Year.
Is it going to be a happy new year for Boeing?
I'm 7 times the charm, I guess. We'll see how it works out in 2025. It looks like they're on a better path, barring any production issues. They've completed a strike. They've done a $24 billion equity raise. They're reducing their workforce by 10%. They still have several issues. Development programs that are losing money in commercial aerospace, which is the 777X, defense programs that are losing about $3 billion this year. So they have their host of issues, but they're focusing on production and improving their cash flow losses.
So let's sit on production. What does output look like now on a monthly basis, and how do you see that ramping up through the year ahead?
So in 2024, they're losing about $14 billion. They were producing 18 737s a month. That includes the strike, so it's a bit deflated intentionally. And then in 2025, they're set to lose $7 billion. So another pretty big loss that's coming mostly from defense and 777X, and also concessions that they're giving away on the 737s, given the strike issues and the Alaska issue last year. But they're improving that to 29 a month on our estimates in terms of production. Then we go to 40 a month in 2026, and that's when you actually start making cash, and you're set to make $8 billion of free cash flow. Why the MAX is so important is it's 50% of Boeing's free cash flow, essentially. 20% is the 787, and the remainder comes from their services business.
We still don't really have a sense of what the main issues were, right? I mean, we have a sense of what some of the potential remedies are with new leadership at Boeing. The Wall Street Journal reporting today that one of the measures they're going to be doing is surprise quality checks in its factories to make sure that everything is on the up and up to prevent the type of jet panel blowout that we saw in the Alaskan Air flight last year. Do you think that that's sufficient? Do you feel like there's been enough transparency about what went wrong and how they're actually fixing it to prevent more of the same?
I debate this all the time in my head because it's very tough to opine on somebody's culture that we're not involved in the factory floor. But it definitely seems like there's fixes that have needed to be done over the last decade. So clearly more focus on moving slowly, doing things better, more open oversight, I think. And these checks probably allow that, given they're random and you don't really know about them coming. So I think in general, when you think about aerospace and defense, it's such a heavily regulated industry, especially in defense production, as well as in commercial aerospace. And what we've seen with Boeing is the FAA has delayed certification of the MAX 7 and the 10 that are not approved yet. And also other aircraft types are having more difficulty entering the market, whether it's business jets or otherwise, just given the scrutiny we've seen post-Boeing.
What does demand look like in a year when a lot of companies, a lot of airlines have postponed purchasing airplanes just because they haven't been available, but also because of some of the security concerns? Do you think that we're going to get some new planes? Just saying, if someone travels and they go into a plane and they know it's old and it gets delayed because they're doing extra checks, I mean, is that going to change?
I think that's where the airlines have a year ahead. I mean, I think that's why they rallied 45% in Q4, the airline industry, because you saw capacity cuts out of the market. And last year, we think we delivered about 1,200 aircraft in 2024. We needed 1,600 to meet just 4% air traffic growth. And air traffic, by the way, is just at 2019 levels last year in 24, which is surprising. It took us so long to get back, and we're not even at the trend line. So every year between 2025 and 2030, we think we need about 1,600 to 2,000 planes. And Boeing has to produce about 75 MAXs. We're at 18 today, or 29 this year. So, Boeing has to produce 50, and you get 75 from Airbus to meet that narrow-body demand.
So at the end of 2025, if you look into your airline creation crystal ball, do you get the sense that Airbus will have actually gained share because of their ability to produce more than Boeing at a time where demand is so great?
Yeah, I think in a global duopoly, Airbus has won that battle, especially on the narrow body side. Not so much on wide bodies, where you see more 50-50 share, but in narrow bodies, it's clear Boeing has fallen below that 50% mark, but that's already manifested itself in the current order book and the skyline. So I think it's Boeing's, the focus for Boeing is to produce going from 18 today to 30 this year to 40 to 50. That's the trend line we want to see. And Airbus has a path. They're around 50 today, going to 75 in the next 2 years.
You mentioned the airlines. What was United doing up by more than 100% last year? I was stunned to see this. The top performers on the S&P 500, United coming in at number 5 over the last 12 months. What's behind that move?
Pretty incredible. I mean, that's what happens when you trade at 3 times earnings. You get a simpler re-rating and you meet numbers. And what we saw was capacity come out of the U.S. market, partially because of Boeing, partially because of folks like Spirit Airlines exiting the market and reducing capacity. So we saw 7% capacity increases in the first half of 24 with the U.S. airline industry. And then exiting the year, we saw 1 to 2%. So more rationalization in the U.S. domestic industry.
Got all this competition coming now over the next 12 months on the premium side of things, Southwest, Frontier, JetBlue as well. What do you make of that, the push into premium by those players?
I think everyone sees that the U.S. mainline market is essentially loss-making to net neutral. So they want to move into the premium to actually be profitable. And then, the next step is international.
Can they compete with the major players?
No, I think what's interesting is we've seen carriers take different approaches to what they want to do with their capital, whether that's buybacks, which we've seen from Southwest, which we don't recommend, or deleveraging, like we've seen from United and from Delta. And they're going down to 1 times, 2 times leverage. So they want to show investors that they could be consumer staple stocks and they don't need to trade at 6 times earnings. And that's where the opportunity comes in for the airlines.
Can you get Lisa to give up Delta One and replace that with something from Frontier through the next 12 months? That's the ultimate question.
Really? Is that the ultimate question?
That's like my ultimate question.
You think that Frontier has like Frontier One, Frontier Plus? I mean, I don't think
I'm
that they're
sure
catering
they can compete with the lounge at JFK.
Yeah, I don't think so.
Or the routes.
Yeah, or potentially the business accounts, I'm just saying.
And everything else. Sheila, it's good to see you.
Thank you.
Big year the last 12 months for you.
Yeah, great performance.
Potentially the next 12 months as well. Sheila Kahyaoglu there of Jefferies. Up next on the programme, Stephanie Roth of Wolfe Research, Mark Cabana of Bank of America, as we count you down to the payrolls report. Not in 5 minutes' time, but in another week. It's next Friday, January 10th. The big one is a week away. The opening bow 60 minutes away following a 5-day slide, the longest daily losing streak going back to April of last year. Can we break that today? Equity futures up by 1/3 on the S&P, on the Nasdaq 100 higher by 0.4. With some movers going into the opening bow, let's cross back over to Manus Cranny. Hey, Manus.
Jonathan, it's official. No deal for steel. Nippon Steel's bid for U.S. steel has been blocked. And the reason, I quote, Nippon Steel might take action that threatens to impair the national security of the United States of America. So this is the Biden administration closing out its era, and it is about protectionism. They have a 30-day quit notice for Nippon Steel. The question is, what does this company become as an independent, if it remains independent, or does somebody step in and buy? JPMorgan say strong standalone valuation. Tough decisions will need to be made. 11,400 jobs and a number of blast furnaces that may be needed to be closed. Stellantis, let's have a look at that. Italian car production is down, but the niggling story here is about access to credits here in the United States of America, not just for Stellantis, but for VW as well. They've been closed out. The Biden administration making it tougher and harder to get access to the credits. That takes the stock down ever so slightly. Now, we got a reasonable response on Chewy when I spoke to you the last time from Wolfe Research. The tagline here is the tail wagging 2025. It upgrades the stock to outperform. Price target $42, 24% upside. The sales lift upside isn't fully appreciated, according to Wolfe. Had a quick chat with AI, and it says that on average, the pet owner here in the United States of America spends between $1,500 to $2,000 a year on their pet. Just make sure it's good quality pet food. Jonathan.
Any evidence, Manus, that they're sacrificing their dental hygiene for their pets, which is what you insinuated earlier on this morning?
You know what? Everybody should look after their personal hygiene, their teeth, health, the dog, everybody.
Punts.
Walk it back.
Yeah, exactly.
Walk it back. OK, thanks, Manus. Stock is up by 2.6%. More broadly, equity futures attempting to bounce back here. We saw this move yesterday. Equities up, and it just did not stick, did not hold through the rest of the session.
And really the theme, frankly, of the morning to me and of the week so far, the two-day week, if people came back after the new year, was this question of, is this the point at which yields start to impede risk assets? And that seemed to be what we saw yesterday, with yields coming up after originally seeing some sort of rally, and that really leading some of the sell-off that we saw more broadly.
Priya Misra of JPMorgan Asset Management making that argument a little bit earlier this morning. For traders, we're looking for the fresh catalyst. It's just around the corner. Data picking up next week, ending with December payrolls before we get CPI on January 15th, the presidential inauguration on the 20th, and a Fed decision at the end of the month. Stephanie Roth of Wolfe Research, Mark Cabana of Bank of America joining us around the table. To the two of you, good morning and Happy New Year.
Good morning.
Good to see you both. Let's start
Year.
with you, Stephanie. Expectations for a week today in a payrolls report?
Yeah, so we're looking for 175 on payrolls, which sounds a little higher relative to expectations. But I think the surprise from the report, just given where markets are, is that it could come into the soft side. Forgetting about the headline number, there could be downward revision to the prior 2 months. And importantly, we're looking for an unemployment rate that could tick up a little bit higher than what expectations are looking for. So there might just be some soft pieces of the report that at the margin could put some downward pressure on yields.
Where's the weakness come from? Because I think the bulls right now would say claims are low, layoffs are low, things look pretty good. What looks bad?
The breadth hasn't been very good in terms of hiring. That's been quite disappointing. A lot of the gains have been driven by healthcare and government, and that's not a sign of a really, really strong labor market. So we think the labor market is fine. We think the underlying trend is 140,000. But at the margin, that's probably a little bit softer than where consensus is at the moment.
Mark, we were talking earlier with Claudia Sahm, and she was talking about how the Fed has really injected a lot of volatility into the market, and the rates market in particular, as a result of its data point dependence. Do you expect there to be quite a bit of volatility either way if there is any kind of surprise whatsoever on Friday's payrolls?
We do. We also think that volatility is going to be a little bit higher in the rates market this year, simply because the Fed is so data dependent, and there's still so much we don't know about next year. How will all these economic policies take shape? What will the impacts be? And so we do think that a very data-dependent Fed in that context will just keep rate vol a little bit higher than it otherwise would have. Now, if we get the kind of number that Stephanie was talking about, if we see some softness in the underlying data, we do think that there's pretty good potential for rates to move quite a bit lower. Largely because we think that there's so much good news that's priced into the market right now. There's so much optimism about U.S. growth remaining strong, about around elevated risk asset valuations, that if you start to see any wobbles in the economy, then we do think that there's a fair amount of a reassessment that's going to have to happen, and that should mean lower rates.
Do you think that that's the bigger potential surprise, is actually some weakness that spurs a rally just based on the positioning so far?
A rate rally, yes. Look, we generally perceive that right now, optimism in the market is extremely elevated, and we've seen that over the last few months. There's a great deal of expectation that this is going to be a super growth-friendly administration, and that's that their scorecard is going to be the S&P, and that's essentially, we think, driven risk assets to very, very elevated values. Whereas we think that the range of outcomes next year is much wider. We don't know exactly what the policies will be. We don't know what the impact on the economy will be. And as a result of that, we think that there's a little bit of a mismatch there. Elevated optimism versus a very wide range of outcomes. And we do think that that should be supported for duration, at least in the early part of next year.
Stephanie, on policy, what assumptions have you made about policy changes from the incoming administration through the next year or so?
So for this year, we think it'll be mostly about deregulation, which is a positive for growth. The tariff thing is, of course, one of the biggest questions. We don't think that will happen until later this year, partially because they want to tie that to TCJA. And importantly, like Mark said, there's a ton of uncertainty when we're thinking about policy. But we think a lot of it's going to be relevant for 2026 rather than 2025. But it's not likely to be that stimulative, right? The TCJA is a $4 trillion tax bill that's going to be just keeping policy as is. That's just to keep policy largely steady. There's going to be a couple of things that could at the margin be growth positive, but then we have tariffs, which are a massive headwind.
Well, just on tariffs, are you saying that the primary objective of tariffs will be for revenue-raising purposes from the incoming administration? Is that what you're suggesting when you're saying the two will be tied at the end of next year?
I don't know if it's necessarily the primary objective. I think the primary objective is, Trump genuinely believes in tariffs, but then they do raise a lot of revenues, and that's something that they're going to need a whole lot of when they're thinking about this tax package.
Mark, you mentioned this, and I think it's important. Policy changes is one thing. Anticipating the economic consequences of them is quite another. It's not obvious to me how inflationary or not tariffs would be. Depends on how they're put together, how they're executed, whether you get retaliation. Also completely depends on what happens elsewhere in foreign exchange, investment decisions made by companies elsewhere that want to be in the United States and want exposure to the US economic story. What kind of assumptions can you make on changes and consequences?
I think it's really challenging for Stephanie and other economists. Look, our economists, I think, have done a very good job trying to dimension to the best of their ability what the key considerations are. But they'll be the first to tell you that the range of outcomes is extremely wide and that their confidence around these assumptions that they're making is extremely low. And you're right, Jonathan, there's so many other things that can impact the potential inflationary consequences of tariffs. Look at CNY overnight, right? 7.3. So you're starting to see the FX markets price some of this in. And to have a lot of confidence around what the overall economic outcome will be is, we think, it's very, very difficult at this point in time. Now, to be overly concerned around inflation, yes, some of these policies could indeed be inflationary. They were not terribly inflationary last time. And what we think the market should be spending a little bit more time is trying to think about, okay, well, what is the Fed's reaction function? Last time their bias was to look through any potential inflationary impact, or at least that's what the transcripts tell us. This time, of course, the macro backdrop is different. Core PCE is more elevated. We just went through a very inflationary period. So will their reaction function be the same? We don't know yet. But to me, that's what I'm going to be looking for to think about what the impact is to the bond market. And right now, my bias is still to believe, and our team's bias is still to believe, that the Fed's likely impact will be to look through to the extent that they can, especially if they start to see that tariffs have any type of negative growth impact. Finally, look, just to go back to some of the points that Stephanie made, I think they're really good. Just think about where the market narrative is right now and what Stephanie said. The policies are probably not going to be all that stimulative. Impact mostly in 2026, not 2025. Where is the market right now? Look, you two talk to a lot of people. You'll know probably better than me. I talk to a lot of clients as well. I generally think that clients' mind frame is that these policies are going to be impactful near term and that they will be quite stimulative. And again, that's where we think market optimism is. Range of outcomes is a lot wider. And again, for me as a rate strategist, I think that probably means lower rates as you see some convergence in this.
We were just speaking to Ed Yardeni, and he actually came out with this fantastic analogy, which is essentially that this is a doctor who prescribed all this different medication without running it through the computer to see which interacts with which. It raises this question of how important is that mix of policies based on where the economy is right now. Stephanie, from your vantage point, Mark's talking about how he thinks too much optimism is baked in from policy perspective. Is there too much optimism baked in with respect to the economic data that we've already gotten in terms of where we are coming from and how much inflation is still in the economy and how much momentum there is?
Yeah, I think that's totally fair. Like these things go hand in hand. So what's baked into the rates market is the expectation that the economy is running on all cylinders, quite strong. And yeah, it is, but it's probably not quite as strong as the outlook suggests. And the FOMC kind of introduced a little bit of extra optimism about the economy. That's probably gonna disappoint to some extent. We'll probably see payrolls running a little bit slower, allow them to actually cut certainly 2 times this year, and the market's pricing in a little bit less than that. So the economy's running just fine, but the expectation is similar to what Mark just said, that Trump's policies are going to be incredibly, growth positive, and they're going to be happening right now, and they're probably not. It's going to take a while for a lot of the stuff to play out.
Do you agree with Mark that the Fed's bias is going to be to look through any of the temporary effects of some of the tariffs?
I think that's what they should be doing, in the sense that if they don't and they start becoming notably more hawkish as a result, that could be a recipe for a recession, in the sense that we are at, largely at full employment. This could become a real problem. If we start to see the Fed reaction function look quite different than what it was last time, we might have a real problem, in which case growth is likely to slow down notably as a result of these tariffs. Tariffs are stagflationary.
Mark, I'm just curious, when you take a look at the Fed's reaction function, we were talking with Claudia, Sahm, and she was saying that they have introduced this volatility. We were just speaking about that. She was saying that they should follow models a bit more, and in particular, some of what she's seeing in the employment market. What would you be following if you were on the Fed as your sort of lodestar for where the economy was heading?
Yeah, look, in periods of very elevated uncertainty, which I think we are in and are going to continue to be in the early part of next year, we think the most basic monetary policy rules can be very instructive, like the Taylor rule. Now, any model is only as good as the assumptions that you want to make and the inputs that you have into that. But we do think that Taylor has been a pretty good guide over recent years. The Fed does not, nor should they, follow it blindly, but they should use that as a meaningful input. Other Fed officials, Chris Waller, has talked about how they do indeed do that. And right now, at least, they've pretty much converged to near where Taylor suggests that they will be. And the big question is, what does the data imply from here? The market thinks that the Fed will only need to cut about 40 basis points more and then they'll be done. But if you actually use the Fed's own economic projections in their SEP, the medians and the unemployment rate, as well as on inflation, core PCE, it suggests that they should really be cutting probably something more close to 100 basis points. And so it really depends upon, again, what are the core economic assumptions that you have. The market's very optimistic right now. I think that growth's going to remain strong. The unemployment rate won't rise much above 4.2, maybe 4.3. Inflation's going to stay sticky. But if you do see inflation move down, or if you do see the unemployment rate tick up a little bit more, then the market's going to be talking about a Fed that could potentially be cutting a lot more than what is currently priced. Look, just final point from me. When I think about the Fed's reaction function more broadly, and I think we in the rates team agree with this, we generally believe that the Fed's going to overweight labor data. And John, you're right. The labor market right now is really strong. Breadth is kind of narrow. We think that the labor market can best be summarized as one where there's not a lot of firing, but there's also an increasingly slower pace of hiring. And the claims data very much points to that. It's still a very healthy labor market overall. Yeah. But continuing claims, really, if you look at a 4-week moving average, they continue to edge up over time while initial claims stay stable. And if that trend continues, I do think that the Fed's going to be seeing a labor market that maybe has less breadth and a little bit more concern than at least what the most recent Fed meeting would lead us to.
I'd be the first one to acknowledge that it won't take much of a downside surprise next week for a lot of people to start pricing in more rate cuts from the Federal Reserve.
Well, that's an interesting kind of dynamic that's changed in terms of where the bias is for this rates market and whether it's set up more for a rally than, say, a sell-off.
Mark, Stephanie, to the two of you, thank you. Good to see you both. Mark Cabana of Bank of America, Stephanie Roth of Wolfe Research. The calendar for the next month, I think you're all familiar with it by now, but some dates for you if you want them. The 10th for payrolls, the 15th for CPI, the 20th, of course, for inauguration, then the 29th for the Federal Reserve. Just want to draw your attention to one single name moving in the pre-market, Rivian, coming out with fourth quarter deliveries coming in better than expected, following the downside surprise that we saw from Tesla yesterday, and a move lower in the stock. Rivian coming in at 14,183, the estimate leads to 13,402.
And before we draw too many parallels, Rivian had been constrained with production just based on component shortages. They said that no longer is an issue of component shortages something that's plaguing them. So maybe releasing some of the production. I remember when there was more on order and they couldn't produce them quickly enough. And, now there's a question of whether that's normalizing.
That's a good problem to have. Yes. The stock is up by about 5% in early trading. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Bloomberg reporting that President Biden is preparing to permanently ban new offshore oil and gas developments in some U.S. coastal waters. It's an effort to lock in protections during his final weeks in the White House that are difficult to revoke. People familiar say Biden is expected to issue the executive order in the coming days. The declaration would not affect drilling and other activity on existing leases. BlackRock's Bitcoin ETF posted a record outflow on Thursday. Investors pulled a net $333 million from the iShares Bitcoin Trust ETF. That's the biggest withdrawal since its launch. Data from Bloomberg also show that investors pulled funds for 3 consecutive days, the longest losing streak so far to date. And in sports, the Fighting Irish are the winners of the Sugar Bowl after upsetting Georgia 23-10. Notre Dame scored 17 points in under a minute and rode a strong defensive performance for the win. The game was played in the wake of the deadly terror attack in New Orleans after being postponed one day. The Irish will now play Penn State in the Orange Bowl. Texas, meanwhile, will take on Ohio State in the other semifinal matchup next week. And that's your brief, John.
Danny, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the week ahead and get you the latest news in the nation's capital. That's up in just a moment. From New York, this is Bloomberg. The opening bell about 41 minutes away, with equities higher by 0.3%. Bond market rallying just a touch, yields are lower by 2 basis points, 454.10. In the FX markets, just some stunning moves to kick off 2025. The dollar absolutely ripping yesterday. The euro getting crushed. Just to see the euro dollar break down through 103 to 102 for the first time since 22. Stunning for the Europeans, and it just speaks to the divergence that so many people have started to expect over the last number of months.
Yeah, and the divergence just seems to be edified by economic data. Yesterday, we got those jobless claims that came out at the lowest level in 8 months. It just raises the question of what is priced in versus what can we expect in a year full of unknowns.
A big week ahead for you, including the first full week of 2025. Before we get to the weekend today, the House holding its speaker vote, plus ISM manufacturing at 10 a.m. Eastern on Monday. Durable goods data on Tuesday, JOLTS data plus ISM services on Wednesday, ADP payrolls and Federal Reserve minutes on Thursday, another round of jobless claims, and then on Friday it's the first big print of 2025. It's the December payrolls report. Before we get there, let's head down to the nation's capital to catch up with Bloomberg's Tyler Kendall as the House Speaker Mike Johnson faces a crucial vote. Tyler, good to see you. How close is this one going to be?
Yeah, good morning, John. It is by no means a done deal for House Speaker Mike Johnson. We know he's been strategizing with President-elect Donald Trump, who's thrown his weight behind Johnson's bid, even going as far as offering to call holdout Republicans if that's what it would take to get their vote over the finish line. I know one of the first things that I'm going to be asking undecided Republicans as they start to trickle in here to Capitol Hill is whether or not they received a call from Mar-a-Lago overnight. Now, I can tell you that I spoke to one congressional aide this morning who told me that this really could come down to a potential deal on spending cuts. And that's because if you look at the Republicans who have been voicing opposition to Speaker Mike Johnson's reelection bid, they're the same Republicans who have been voicing concerns about what a future potential Trump agenda could mean for the fiscal outlook of the country, particularly when it comes to anticipated tax cuts. But John, it's important that when we are talking about a potential Trump agenda, if Republicans can't solve this today, that could bode badly for the party, considering if we look ahead to just Monday, January 6th, Congress is expected to count and certify the 2024 Electoral College votes. Yeah. And party leadership has made it absolutely clear they want to see that go off without a hitch.
Tyler, before we get into some of the other developments this morning, including the Nippon Steel deal, we did get a message from Donald Trump on Truth Social saying that Speaker Johnson is, quote, very close to having 100% support. Do we have any backing to understand whether that actually is the case?
So the key thing to remember here is that Speaker Johnson would need a majority of the votes in order to clinch the speakership. If everybody shows up to vote, which isn't necessarily a given, but let's say they do, then that magic number he needs is 218. He's coming in to this Congress with 219 Republicans, which means he can only afford to lose one vote, and we already know that he has. Congressman Tom Massey, a Republican from Kentucky, has said unequivocally that he will not be voting for Johnson, and there hasn't been any latest reporting saying that he's changed his mind there. When you're hearing Trump say that he could have unanimous support, we also have to keep in mind that Democrats are by no means going to come to Republicans' rescue on this one. We are expecting all 215 Democrats to vote in favor of Democratic leader Hakeem Jefferies.
Tyler, Lisa mentioned earlier this hour the President of the United States, Joe Biden, coming out and officially finally blocking Nippon Steel's proposed takeover of U.S. Steel. Is there anyone in opposition to that decision down in Washington, D.C.?
Right. This wasn't necessarily a surprise here in Washington. Biden issuing this statement earlier this morning ahead of a January 7th deadline for him to decide. And in that statement, really harping on this idea that he's trying to protect American steelworkers. We saw this as a flashpoint in the 2024 campaign. President-elect Trump also during the time saying that he would block the deal. And I will tell you that back in May, I had actually caught up with Senator J.D. Vance before he was vice president-elect, who had an interesting view on this deal, particularly because, of course, he's from Ohio, and we know Cleveland Cliffs was also bidding to be part of that merger. And he had told me at the time that he understands that Japan, of course, is a close ally, but ultimately we have to recognize the national security concerns around this, particularly considering how close they are in the region when it comes to China. So we're going to be checking in with the Trump transition team today to see if there's any updates there on that thinking, but that's what we were told at the time.
Tyler, appreciate your time. Great reporting as always. Looking forward to your coverage through today. Bloomberg's Tyler Kendall there with US Steel in the pre-market down by something like 8%, and the path forward for that company very much unclear.
It seems like they need to do something, whether it's divesting parts or possibly selling themselves to another bidder. And a lot of people were saying that Nippon Steel was the best potential option for them. The national security concerns are interesting. The fear is that there could be some sort of flooding of the market of cheap steel to reduce the value or potentially the market share of U.S. Steel. That had happened in the past. A question going forward about what this means for international companies investing in the U.S. and which areas are important to sort of preserve for national security versus are up for grabs.
I do wonder if we get a change of mind from the incoming administration.
You think?
Watch this space. Who knows? Got to change your mind on TikTok, didn't we?
Oh, well, yeah. I wonder if this actually amps up the pressure on that. Yeah, I mean, he's already said that he wouldn't necessarily, that he would block the deal. So we'll see. I can't imagine. Politically, do you think that that would be feasible?
Who knows? He's not running for election again, is he?
That would be
so,
interesting.
Who knows? Honestly, watch this space. I think we've got to be open-minded about absolutely everything. How do you feel about a two-day week?
I think that's a fantastic idea.
I think it could catch on.
I think very much
I think it could catch on. It works for me. I don't know if it works for you. Coming up on Monday, looking ahead to next week, fantastic lineup for you. As we look ahead to Payrolls Friday, we'll catch up with Laurie Calvasina of RBC. We'll speak to Jane Foley of Rabobank. What a year already. Only 2 days in for foreign exchange for both the euro and the Chinese currency. Levels we haven't seen on the euro since 2022, for the Chinese currency since 2023. We'll speak to Liz Young-Thomas of SoFi as we start to see this bond market constrain returns in the equity market. Priya Misra of JPMorgan Asset Management earlier on with us this morning. Fantastic on that. And Michael Gapin in a new seat at Morgan Stanley, looking ahead to Payrolls Friday. The estimate's something like 150 in our survey, down from the 200-plus gain we saw in the month before. From New York City, that does it for us. Have a fantastic weekend and a happy new year to you all. We can stop saying that in about a week from now. This was Bloomberg Surveillance from New York. This is Bloomberg.